Hey, good morning, everybody. Big news, 1 minute. The feds are going to talk. It is high impact. Should we watch the NASDAQ and see what it does? Hope you guys are doing well today. Hope everybody is excited about Friday. How do? I do all right. Um, Welcome to the room, guys. Welcome to Friday. We made it through the week. A lot of great lessons. Hey, TLC, Gino, Bob, Zorro. Nice to see you guys. Haji, great to have you. So I went to forexfactory.com and Friday, March 23rd at 9 a.m. it says Fed Chair Powell is going to speak. That's high impact. And guys, good morning, Andy and Grant. I don't particularly care for trading in front of high impact news. It can create this big emotional run in the market. It can create all sorts of sideways movements and ups and downs and lefts and rights. And the other side of it is it may do absolutely nothing at all. And the reality is you just never know. You don't know what's going to happen on those news releases. But if you pay attention to high impact, if you pay attention to medium impact, you give yourself this huge advantage of not going head first into the emotional freight train that is news reactions. And again, some of them are duds, and some of them are so volatile that you just couldn't even think to take a trade. And so far, it's slow rolling, but he's probably just now talking. So we'll see what happens. But I come here every morning, guys. I check out news. I make sure that I'm not jumping in front of it. There's a lot of the proprietary firms that absolutely forbid you trading during news. Just something to think about. So that's my first morning routine. And then we go to everything that I talk about comes from the tutorial section, guys. There's zero secrets. And the best part is if you feel like you're missing out on something, all you have to do is raise your hand, and we'll get you those lessons. And then if you get a lesson, so for example, yesterday Rob was nice enough to say, "Hey, Mark, let's talk about PSOs. Let's talk about pivot stop outs. I just want to make sure that I understand them." So not only did we cover it, I think we went through it pretty well, but it's also available to you on the YouTube channel. So whenever you get one of those great lessons in class, guys, don't be afraid to go back and revisit it on the YouTube channel. There's the whole live section. But I want to talk about today. It's really the same thing I talk about every day. I'm not sure if you guys have noticed this, but I am very much a broken record. I try not to reinvent the wheel every day. I try not to make anything more difficult than it needs to be. And every morning I talk about high probability trend trades. I talk about trades where each indicator on every chart agree for the trade. Triggers are going to be their strongest. No termination conditions exist, and there's no trouble spots between your entry and your target, guys. This is the first thing that I talk about every day, and I do it because this is the foundation trade. This is the trade that gives you this solid platform to grow from. From a high probability trend trade, you're going to ultimately take medium probability trades, but you're going to understand when they're medium probability, and you're going to understand that they need to be managed aggressively. And one gets you to the next. So this morning we're going to do what we do, and we're going to talk about high probability trend trades, and we're going to do it if for no other reason. It makes you a chart reader, guys. The most important thing, and I guess this is it, is most of you have purchased or leased or are running demo on software, and that's what it is, guys. You didn't purchase the ability to trade. You didn't purchase the right to victories. You didn't purchase the divine intervention that gets you profits. Good morning, JW. What you did is you bought or you released, or you're demoing the best software on the planet. And I firmly believe that. But you've got to learn to read it. You've got to learn to understand what the software is telling you. And that's it. Buying a car doesn't make you a driver. If I put you in the oven, it doesn't make you biscuits. I worked with a lady that used to say that. Um, so chart reading, guys, is really what we're going to do. Chart reading is the first and foremost. Chart reading is about 90% of your day. 90% of the time, you're just looking at your charts and you're asking yourself, do I have the advantages that I need to take a trade? And chart reading is going to have you understanding where the market is likely to continue. And for the brand new user, this becomes the entry for the highest probability trend trade. And then you're going to understand where the market is likely to go. And again, for the brand new user, this is going to help you pick exits from that high probability trend trade. And then most importantly, I think, is you're going to understand where the market is likely to stop. And this is, again, for the new user, where you shouldn't be taking any more of those high probability trend trades. When you reach areas that may stop or reverse or create bounces in the market, it's this huge red flag, or at least it should be, maybe with an air horn next to it, saying don't go into this section, don't trade into this area that's likely to stop the market. So we focus heavily on the high probability trend trade because it will make you a chart reader. I promise you this, it will make you a chart reader. And if you're still struggling reading your charts, if you're still making maybe the same mistakes over and over, this morning I will cordially invite you to take a break from simulator this morning, to focus on the classroom, to ask questions about the things that you don't understand yet. And what I find is that people get so excited about trading that they forget to take all the lessons in. I would love to learn about likely to stop areas, but I'm in a trade, right? Well, that likely to stop area may help you in your next trade. We talk about chart reading so extensively, guys, because that's what leads you to trade entry precision. That's what gets you into the market is your chart reading. And then once you're in the market, you're going to have to manage it. You're going to have to do something with it. Give me 1 second. Let me tell my brother that I'm teaching class. My brother loves to share in the morning. I don't know about you guys. I've got a mentor. And my mentor is absolutely slaying it this morning. He wanted to make sure I knew that coming into class, apparently. But I really do. I have a mentor. My brother is my mentor. My brother is who I present my charts to, and my brother is who I ask for help when I need help. And if I don't understand a concept, I run it by him. Or if I misunderstand a concept, I run it by him. And I do it the same way I ask you guys to do it. I do it by presenting pictures to him, by annotating my charts, and by making sure that I accept the feedback, that I get the feedback, that I understand the feedback. And if I don't, I make him talk it out. And some days it pisses him off. But most days he's very accommodating. He's at least 5 for 5. I bet you there's losers in there, Gary. There's always losers in there. So your step-by-step path is no different than the path that I had to take to become a chart reader. Post your trades in class, guys. Talk about what you see. Ask for help. Tell me how you're reading your charts, because chart reading is the goal for the brand new users. And then the second thing is use the spreadsheet that Nexgen gave you. This is in your Nexgen Study Picks folder. Whoops. I'm also about to drop it right in the classroom. So you can have my copy if you don't feel like searching. But there's 3 tabs on the spreadsheet. The first tab is a copy of your tracking. So when you are on simulator, when you're practicing these trades, and then guys, put your listening ears on real quick. Even if you're live, if you've gone to Apex, if you've gone to live accounts, if you have begun trading real money, don't go past. Guys, give me a Y if you can hear. Can everybody hear or nobody hear? Okay. So we can. So TLC reboot, my friend. Okay, so we'll do that. And if you guys ever can't hear, make sure you tell me. And then if you see all those Y's come in after, it means that it's just you. Let me make sure he gets that at the bottom. There we go. So hopefully we can get him back in and taken care of. Guys, this first page is not only your sim trades, This is your live trades, and this is probably one of the most valuable tools for you guys. Not only as you get close to going live, close to trying to pass these prop firms, but guys, once you're live, you have to make sure that you're continuing the same path that brought you the success that got you to going live. So every morning, study what you did yesterday. Even if you had the best day ever, go back and study what you did yesterday and ask yourself what worked and what didn't work and what felt easy and what felt forced. And what you're going to find is that through this little study each morning, it's going to set you up for the day because you're going to be thinking about those things that brought you success. And you're going to be thinking about those things that maybe took that success from you. Um, it will accelerate the learning, but not only will you see the patterns in the market that are great for the plan, but you're also going to see the patterns that aren't. And then more importantly, and guys, I think this is such a key part of the educational process, is when you study your previous trades, you're going to find patterns in yourself. You're going to find the patterns in you that need to be fixed to get you to that next level. And maybe it is jumping into trades early because you're afraid you're going to miss them. Or maybe it's holding trades too long because that little devil on your shoulder says, yeah, but what if it does what it's supposed to do, even though it's not doing it? So studying this it's gonna really set you up for each and every day. The second page, the favorite looks page, guys, this is how you develop your trading plan. I'm going to give you a trading plan initially. I'm going to give you the most concrete set of rules that enhance your chances of success. But it's really imperative that you know what these looks are. So even though you have a written plan for it, go back this weekend and find pictures of it. Find 20 pictures of the perfect long and find 20 pictures of the perfect short and start filling up this trade looks section. Because recognition comes through repetition, and the more time you spend focused on the individual pieces that bring success, the easier it is to tie them together to find that success. And then finally, here's the client trades. And my hope and wish for you guys is that you'll turn your section, your favorite looks section, this one's all you. This isn't Nexgen's favorite looks. This is Bob's favorite looks. This is Grant's favorite looks. Make it look like the one that I've provided you here with about 300 pictures of people using the software, with entries, with exits, with sections on management and patterns that repeat themselves. And then the Mark Novak shouldn't trade here. That was a little joke from yesterday. But what this is termination conditions. These are those likely to stop areas. But that's there in the spreadsheet for you. Make your section look like this, guys, because I promise you, if you take 15 pictures a day and annotate 15 pictures a day, that's 300 pictures a month, guys. That's 3,600 pictures at the end of the year, however you want to do the math. But that recognition comes through repetition. Being able to see these patterns when nothing is moving makes it easier to catch them when everything is moving. So use your spreadsheet, take your pictures, post in the room, raise your hand, use your voice. Don't be passive in your education process. Be very self-centered. Be a little egocentric and demand that we get your questions answered, because that's my job and that's what I like doing. But we're going to spend the first hour learning. Good morning, Farak. We're going to learn the trigger line and Fibonacci rules for when it's okay to trade for the high probability trend trade. We're going to talk about them extensively. We're going to look at them in pictures. We're going to find them in the live market. And guys, we're going to do wonderful things with our chart reading in the first hour. Simulate your trades. Get through there. Play on simulator. It's totally cool. But if you're trying to absorb the lessons, guys, make sure that you focus on learning the rules instead of taking the trades, right? You'll have plenty of time to simulate. And I like it when you guys do it. Get in there. If you see something, take it. But if something comes up, if you're like, man, I'm not good at this momentum thing, well, then just take your hand off the mouse and listen to momentum. We want you guys trading the correct rules. We want you trading with advantages. Getting lucky feels good. It's a short-term victory, but trading statistical advantages, guys, that's long-term success. And when you tend to get lucky and you get excited about that pretend money, that monopoly money, adding up in your simulated accounts, it rarely translates to that long-term victory. We're going to talk about the high probability trend trade. We will simplify. You guys are taking pictures like tourists. Like, I mean, pictures of everything, writing down everything. This is your trading journal scrapbook that you're creating. And the more pictures you take and the more charts you annotate, the easier it becomes to recognize these trades in the moment. So let's get to the high probability trend trade. 3 rules. That's it. It's you're gonna be what's the word I'm looking for? You're gonna want to create more rules. You're going to want to establish more scenarios. You're going to want to fabricate more instances that must happen, because your brain is going to tell you if 3 rules is good, then 72 rules has got to be freaking amazing. And it's just not true, guys. The easier you keep it, the quicker you're going to find the trades. The less you look for, the more you find. It's so true. Each of these rules is designed to give you an advantage. Your first rule says that you must have strong triggers. Strong triggers provide you the advantage of momentum. Your second rule says termination conditions false. And your second rule will give you a clear path, nothing between you and your target. That's room to your targets. And then your third rule is designed to get you into the market once the other 2 advantages are in place. And that's going to put you in where the market is most likely to continue. This is the recipe for a trade. Momentum, a clear path, and an entry area for the new user is the recipe for the trade. A trade isn't, I think the market's going to go up. A trade isn't, I hope this area breaks. A trade isn't, well, I'll jump in here and see what happens. A trade for the brand new user is an accumulation of 3 advantages. So I want you guys, every time you look at a chart, I don't want you to say, is there a long? I want you to say, are my rules met for a long? Don't say, hey, I think I see a short. Say, hey, I have those 3 advantages that tell me to go short. And if you start speaking in terms of advantages, you're going to recognize when maybe one of these advantages isn't present, and it's going to allow you to manage more assertively. It's going to put you into that medium probability scenario. But first, we're going to figure out the high probability. And the high probability scenario is a 2-chart process, guys. The large chart is the most current bar. It's a broad stroke of a brush. It is a slow moving train. And that large chart is, is where really the advantages start. The large chart, whoops, what did I do? Is this broad stroke of a brush that gives the overall opinion of the market. It's this broad stroke of a brush that tells you what the people in charge want to have happen. Guys, I always like to think of my 2 charts as 2 different crowds. The large crowd is full of money. They've been drinking Red Bull all morning, and it's just not a good fight to pick. The small crowd has just enough money to be dangerous, just enough money to be house poor, right? And they fight the large crowd whenever they can. They're probably wearing leather jackets and smoking cigarettes. Maybe they have blue hair. I don't know. These are the punk rock crews. And what they do is they fight, but we utilize them to get us where we need to be. We utilize that small crowd so that we can capitalize on what the large crowd says. So the large crowd is going to define the direction of the market. These guys, if they want it to go up, it's going up. So one of the advantages we can give ourselves is only go the same direction as the large crowd. The large crowd is also going to create momentum. And once again, one of the advantages is we're just going to go with that momentum. That's what rule number 1 does for us. And then the large crowd, these are the guys that when you see those blue lines, those red lines, those yellow dots, the large crowd reacts at those areas. The large crowd literally will see Fibonacci resistance, and sometimes they'll exit positions, and sometimes they'll enter positions, and sometimes they'll take half off, and you'll see these fights at key areas. So they're going to define the areas that may be problematic, that may become those likely to stop areas. Excuse me. And when they haven't gotten there, that gives us a clear path. So your first 2 advantages, 66% of the goodness comes from the large chart. And when the rules are met, you're going to turn your attention to the small chart. And what happens inside of this one bar, the most current bar on the large chart, will be 15, 30 bars on a smaller, faster chart. We're literally going to take an X-ray of it. And we're going to use that X-ray to pinpoint exactly where the market is likely to continue. And by using the smaller, faster chart, if everything says up on the large chart, we are literally going to buy Fibonacci support on a pullback on the small chart. And if everything says down on the large chart, we're going to sell resistance. We're going to sell high on that smaller, faster chart. And that's really the amazing thing of this two-chart process is we can take this huge broad stroke of a brush and then refine it down to the point where the market is most likely to continue. This allows you to reduce risk. This allows you to maximize your profit potential. So the large chart says strong triggers. Strong triggers provide momentum. This is rule number one. And strong triggers can only happen if the background matches the trigger line color. So the background color defines the direction of the market. And let me throw this out here real quick because this is a very important lesson for everybody. When I speak about the high probability trend trade, guys, when I talk about this trade that typically wins 70 to 80% of the time, when I focus on these rules, it's imperative that you guys understand that we're building a foundation for the new users. So for you new users, I blanket with very conservative rules. And everything revolves around advantages. And everything revolves around learning to read your charts, learning to read your indicators so that you can understand how to take more trades. So when we talk, guys, I'm going to tell you that the only way to have a long trade is with the advantage of momentum. And the only way to have momentum is if the colors match. If the background is green, you're looking for long trades. If the background is red, you're looking for down trades. But what happens is as you grow with the software, as you become a chart reader, these rules will change a little bit for you. Your perception will change a little bit. Your ability to find advantages outside of the best, it will change. But until you're a chart reader, guys, these are blanketed rules. These are designed to keep you safe and focused and capable of taking the absolute best of the best. So in order to take the high probability trend trade, your trigger lines for strong triggers have to match the background. And if the background is green, it means that your small triggers, these solid lines, and your large triggers, these dashed lines, also have to be green. And if they're not, there is no way on God's green earth that you can have momentum. Not the kind that we're looking for to take the high probability trend trade. So all the colors match. And when the small triggers break above the large triggers, and space is created between the two, it looks like scissors that are opening, ready to cut. This is strong triggers. This is rule number one being met, and the odds are favorable for the market to continue up. This advantage of momentum typically carries the market in whatever direction it's going. This advantage of momentum has the potential to break those key Fibonacci areas. And this advantage of momentum for a lot of you guys is the basis for everything that you do. And it'll even hide some of the mistakes that new users tend to make. When the background is red, the small triggers, solid lines, have broken below the dashed triggers. The large dashed lines, it's the space between the two, like scissors open. Guys, this is odds favorable momentum. The odds are favorable for the market to continue down. This is your first advantage. This is exactly what it looks like, and it doesn't change. The colors match, the separation is there, the colors match, the separation is there. And what that means is that right here where one is red and one is green, you can't have a high probability trend trade. You may have a trade as you grow with the software, but it won't be high probability because that is not odds favorable momentum. Is everybody comfortable with, it's a very basic look, and let me pull up a large chart real quick. Odds favorable momentum means that the smalls are above the large are wide, and look at the space, and guys, look at how far that market runs with all that momentum. There's space and the market is just screaming to the downside, right? And then we get that space and it's flying to the upside. And I promise you, odds favorable momentum should be the basis for most anything that you ever do, because momentum can break areas. Momentum can carry that market. And guys, when we have odds favorable momentum on the large chart, that's when we're going to buy Fibonacci support on the small chart, or that's when we're going to sell Fibonacci resistance on the small chart. And it looks like a tail on the large chart, because remember, the large chart, does everyone remember that super cool lesson? It's one bar. It is literally one bar on the large chart, which means that when we refine it, when we enter on a small chart, you guys will be able to pinpoint exactly where these tails are most likely to happen. But odds favorable momentum isn't a 24/7 endeavor. You're going to have odds favorable momentum to the downside. There's space between the triggers. Life is good, and each and every one of you will be capable to pinpoint exactly where that tail is most likely to form. And then with both triggers down, when one of the two small triggers is inside of the large triggers, this is the first sign that momentum is slowing. And this takes you outside of the realm of high probability. It puts you into medium probability, and short trades can still be taken as you grow with the software. You're just going to use your chart reading to make sure that the other charts agree. And then once both triggers are down and both of the small get inside of the large, those scissors have closed. You can't really cut anymore. You can only take a stab at things, guys. This is what we call a weakening of the large triggers, and it's a weakening and a slowing of the trend. And anything can happen up or down. That's it. You're going to hear that in class all the time. Anything can happen triggers. And guys, the reality is when you have anything can happen triggers, anything typically happens. You throw away your advantage of momentum. And not only will this create bigger retracements in the market, but if you have those super weak triggers and you reach Fibonacci support, resistance, that area is more likely to stop the market, more likely to create an untradeable bounce. So rule number one, man, that's the one. Momentum, you'll see in this classroom posted by people, you'll see high probability trend trades, which are just a momentum trade using a large chart and a small chart. You'll also see momentum style trades where that momentum fuels entries and it allows you to exit without momentum. And knowing what you're getting into really sets the tone, guys. So once it's screaming in the direction, once the odds are favorable, we have to make sure we don't hit something solid. We need to make sure we don't reach one of those termination conditions, one of those areas that are likely to stop the market, because that's where decisions are made. That's where the large crowd is going to define your areas. So the small crowd's already given you direction, or the large crowd's already given you direction. They say, Nexgen users, I want the market to go up. And they said, I'm so hell-bent on the upside that I've created odds favorable momentum. So now we're going to make sure that they don't reach an area, that they haven't reached what we call a termination condition. And termination conditions are Fibonacci-based indicators that may reverse the market. And may is a very key word there. It's not guaranteed. Areas break, otherwise it would just rattle in between two lines all day long. These areas may reverse the market, but it's based on a comparison of the area and the T3 trigger line strength and location. So we're going to use those areas on the chart. And let me pull up the picture, and I'll show you the areas too before we get into it. We're going to look for red Fibonacci resistance, blue Fibonacci support. We're going to look for these yellow 1-to-1s, divergence high lines, and divergence low lines. And the key is that once we identify the areas, we're going to use the trigger lines to determine whether or not they are likely to stop the market, whether or not they have the potential to break, or we're going to use the trigger lines to recognize when they have broken. Let me give you guys this. This is a cool little roadmap for the new users. Drop it in your spreadsheet. So what we're going to do is we're going to do a little comparison. And the comparison really isn't difficult. But I want you guys to really grasp onto this first part of it. Price reaches an area. Your dynamic Renko bars reach an area on the large chart, whether it is a fib, whether it's a yellow 1-to-1, a divergence high, a divergence low. The only way to have a termination condition is if price reaches an area, because that sets off the decision-making process. When price reaches Fibonacci support, this is where maybe the sellers say that's enough, we're taking profits, It's also the potential spot where buyers say, hey, I've got 10,000 shares that I'm going to buy, and we're going to create an untradeable bounce. We're going to reverse the market. And I want you guys to accept the fact right now that you don't know what's going to happen. This guy knows what happens. Guys, this is the deep pockets investor. This is the guy that reacts to the areas. You guys have this amazing advantage. All you have to be is a remora. Let him do all the work, or her, could be a her. Let them do all the work. Let them establish direction, momentum. Force them to react to areas, and then we'll find ours in between. So if price reaches an area, this case support, check the trigger lines. If they're not below support, don't take any more short trades. It almost sounds too easy, doesn't it? If price hits an area and the triggers remain above it, don't take any more short trades. And then if price reaches resistance and the trigger lines remain below it, don't take any more long trades. You've reached a termination condition. This is an area likely to stop the market. Once again, new users, I am blanketing you with the most conservative way to trade the market in the beginning. Because the more conservative you are, the more likely you are to win. And the more likely you are to win, the more confident you become in a shorter span of time and the more focused you become on advantages. So price reaches, no triggers, no trade. Well, when is the area broken? When can I take the trade? When both the small triggers, both lines, and the large triggers, both lines, get above or below the area in question. So in this case, price reaches Fibonacci support. The triggers remain above. There's nothing for us to do, guys. We don't know if it's going to break or bounce or who knows. But once the small and the large get below the line, well, the line becomes the opposite. So support becomes resistance. Resistance will become support. And I want you to see this really cool thing, guys. Your patience is rewarded when the small and the large break through because it has odds favorable momentum. The most current bar hasn't reached support yet, and it's cleared the previous, so my path is clear. And then each and every one of you just pinpointed where that tail was most likely to form on a smaller, faster chart. And that becomes your high probability trend trade. So for the brand new user, it's either price reaches, no triggers, no trade. Both sets of triggers get through. Let's look for the rules to be met until we reach the next termination condition. Is everybody okay with that? So we're going to go back and we're going to look at our large chart again because that's what we do. Price reached, yellow 1-to-1s. Even with odds favorable momentum, guys, look at the bounce. Guess what? You just got stopped out of a trade because you ignored rule number 2. Weak triggers, look at the pullback. You just got stopped out of a trade because you ignored rule number 1. Eventually, small and large get through the area breaks, and you're looking for opportunities, and there isn't always an opportunity. Guys, that was a big emotional spike down. Price reaches Fibonacci support with weak triggers. They don't break through. There's a pretty good bounce, but it turns out the sellers weren't done. The buyers didn't have enough in them. Weak triggers gives another bounce. But you don't have your colors matching. You don't have a clear path. And again, the buyers tried, but the sellers weren't done. And then they reach the divergence low, and all the triggers stay above. Now it's a termination condition, and look at that. That's what started the ramp up. So you can literally see the fight in the market, guys. You can see buyers and sellers fighting. You can see the buyers testing the waters, trying a little harder. Then ultimately you get that no trigger line through termination condition that reverses the market. That's a strong bottom. That sets you up for the highest probability trend trade. Weak triggers didn't break. The market pushes all the way down to support. Doesn't break, pushes all the way back to resistance, all the way back to support, all the way to the divergence line. And we're back at support with absolutely no triggers through. Ladies and gentlemen, rule number 2 just kept you out of 5 losers. So I want you to take a little time. And I want you to learn this rule 2. And I want you to study this rule 2 because 90% of your day is waiting for everything to be right, waiting for that statistical advantage. So price reaches resistance, no triggers break, no long trades. Let's keep it easy. Price pushes all the way back down to support. All my triggers are above, no short trades. Let's keep it easy. Price goes all the way back to resistance. No triggers break, no long trades. Let's keep it easy. It reaches that divergence high line, no triggers break. Now it's a termination condition. Reaches a second resistance, no triggers break. 3 terminations in the same area. Guys, this is a pivot stop out. When the market comes up, and here's your lesson on pivot stop outs, ladies and gentlemen. I took a picture this morning just to illustrate so that we could use the language. And let's talk about pivot stop outs. When price goes down and up, it creates a pivot. So I want you guys to all give me a Y in the room, especially if you're working on pivot stop outs. Price goes down and up. This creates the pivot. Because there was a loss of momentum when price went up, this creates the divergence line. So I want you guys to think about it like that. Price creates this line. Price didn't reach an area, price created an area. And if price didn't reach the area, everybody give me a yes, let me know that you know it can't be a termination condition because price must reach an area for there to be a termination condition. So we're good there. From there, price pushes up. That's what creates the pivot, is the down and up. Hey, good morning, Cab, just in time. And you'll notice that price does push up. And they couldn't finish the move. The large triggers never get above. The small triggers never get above this fib. And the market pushes back down. When it reaches the divergence low, now price has reached an area. And guys, I'm going to ask for a lot of Ys because this is a pretty misunderstood concept. Here, price creates that line. That loss of momentum gives me that cyan line, light blue. And here, price reaches the area and the triggers remain above. Guys, now I have a termination condition. Price reaches, triggers don't break. So is everybody good with that? First, it's a pivot. Then it's a termination condition. And then when price trades back above that divergence high, now it's a pivot stop out. Here's your pivot. First, it has to be a termination condition. But when price goes below and back above, that's your pivot stop out, guys. That is a termination condition that's got a lot of power to it. That's a termination condition that when price trades above a divergence high line and back below, or of course, you know, on the other side of it, if price trades, if price trades below a divergence line and back above, no more short trades into that area. And then if price trades above and back below, no more short trades. It's a pivot stop out. So that divergence high is first a termination condition. And then it becomes a pivot stop out with the price action that goes above and below. So no long trades, no short trades, no long trades, but eventually from this termination that reverses the market, I get odds favorable momentum. I also get a clear path, and there's one of those tails, guys. There's one of those points where this is the highest probability trend trade you can take. This is the best of the best. This is the one that typically wins 70 to 80% of the time, the one that creates confidence through the memory of success. And guys, sometimes you have to wait a while for that to happen. 90% of your day is spent reading indicators. This looks very much like what we just saw on the NASDAQ. Price reaches yellow 1-to-1s, no shorts. Back to resistance, no longs. Back down, no shorts, no longs, no shorts, no longs, no shorts, until eventually it breaks that range. It breaks that resistance. All the triggers get above it. I have momentum, and we pinpoint the best of the best area. So let me show that again on my large chart. The triggers don't break, they're weak. Back to support, to resistance, to support, to resistance, to support. And now we're coming up on a divergence high. Do you see how support didn't break? And we're coming into that divergence high. And guys, the only way that I'm trading from this range, rule number 2, has kept me safe for 23 minutes. The only way I'm going long is the top of this established range breaks. And the only way I'm going short is if the bottom of this established range breaks. And I can spend the next 25, 30, 40 minutes trying to guess, giving away the money, taking trades based on my opinion rather than the rules being met, or I can just sit on my butt and wait for it to be perfect and get paid, or at least get paid more often than not. And exactly, Rob, trigger lines define whether or not an area is broken, not the price bars, but trigger lines define whether or not an area is broken. And all of you thought that it was going to go up because of support, and I'll be damned, now it's pushing back down. But Mark, the triggers were green, but the background is red. I can't have momentum. Well, now the background's red, Mark, I better go short. But all of my triggers are above support. Rule number 2 is not met. I'm telling you guys, these rules are designed to keep you safe. These rules are designed to let you know when the buyers and sellers can't figure it out, when neither one of them can take a foothold and push the market decisively. So termination conditions, guys, study them, ask questions about them. Cab, did you catch the PSO lesson? I know you just walked in right at the beginning of it, but I also know that the NASDAQ didn't have anything setting up. So price creates the divergence low. When price retests it, it's a termination condition if the triggers don't break. When price goes below and back above, now it's a pivot stop out. So I see a lot of people labeling this a pivot stop out. It's just a pivot. And I think that, let me give you guys this picture. Hopefully that's helpful. And we took a couple yesterday. I'm just going to revisit it one more time. This is a pivot. This is a pivot stop out. This is another pivot stop out. And it's also 3 divergences in the same price range, which is going to be my segue to what we're talking about next. Large chart defines the areas, guys. Large chart lines tell you when you've reached a point that may stop the market, that may reverse the market, that may create that fight that we don't want to be involved in. This next termination condition is going to happen on a small chart. Because remember, the small chart is 15 to 30 bars for every bar on the large chart. So we're going to be able to use that same loss of momentum, that same idea of divergence, letting you know that there was a loss of momentum. And when it happens 3 times in the same price range, guys, that may terminate the trend. Notice there's that word may again. It's not guaranteed to. It doesn't say, hey, if there's 3 divergences, let's go long. It just says, you know what? Shorts might stop for a while. Longs might stop for a while. And guys, this is the only look on a smaller, faster chart where I will say in my head or out loud, rule number 2 isn't met. I no longer have the advantage of a clear path. 3 divergences becomes even more powerful when your small triggers work their way inside of the large triggers. Some of you will remember that as a weakness, as an anything can happen look. It becomes more powerful still when that final pivot is higher than the previous from a low or lower than the previous from a high. And guys, this look at a low and this look at a high is going to give you the advantage of understanding when that market may be turning before it reaches the line, where that market may be turning even with momentum before it reaches the line. And guys, this is termination conditions. Termination conditions are 99.9% on the large chart. There is the rare exception where 3 divergences on a small chart will keep you out. But for the brand new users, these are your options. You can have it when price reaches the area and none of the triggers are capable of breaking, and you say to yourself, the area is not broken, rule number 2 isn't met, this is not a clear path. There's the option over here where both the small and the large get to the other side of the area. Now the area is broken and the path is clear until you reach the next area. And then there's the medium probability scenario, guys, and this is where the area has the potential to break. And it has the potential to break because of the momentum. But it's not a broken area until both sets of triggers get above. Therefore, it's not a clear path. And if it's not a clear path, guys, then then it can never be a high probability trend trade. So 3 options for the brand new, or for the brand new user, there's 2. It's either broken or it's not. Once you get comfortable with that, you'll start adding in those 50-50s. You'll start adding in those areas with the potential to break trades. So large chart, first bar has defined direction. The background is green, the market's going up, and I really want to be a part of that big crowd party. The large crowd has also established momentum. My smalls are above the large are wide, everything is angled in the direction of the trend, and my scissors are open. There's space between the two. Rule number 1 is met, therefore, I do have the advantage of momentum. Price has not reached Fibonacci resistance up here, and I have to check my rear view. Price has cleared Fibonacci resistance down here. It's now behaving as support. The most current bar has not reached resistance. Guys, I have a clear path. Rules 1 and 2 have been met on the large chart, which means that with everything up, I'm going to buy low on the smaller, faster chart. I'm going to use that refinement chart to buy Fibonacci support. Or if everything were going down, I'm going to sell high. I'm going to sell Fibonacci resistance on a smaller, faster chart. And I'm going to do it with rule number 3, guys. Rule number 3 gives you the advantage of entering the market where the market is most likely to continue. Rule number 3 is designed to reduce your risk. Rule number 3 is designed to increase your profit potential. Rule number 3 is designed to give you the absolute best of the best entry so that you have the most manageable trade. And rule number 3 says that I'm going to use a limit order. I'm literally going to wait for the market to come back to me. And I'm going to use that limit order to buy or sell a pullback at an area. Areas on the large chart define problems. Areas on the large chart were decision-making points. Areas on the large chart were giant red flags saying don't trade into them. On the smaller, faster chart, we're going to use areas to trade from. Areas are going to be used for entry points, but the key is that they have to be at trigger lines. They have to be inside of what we call favorable large triggers for the new user. And what is a favorable large trigger, Mark? Well, I'm so glad that you guys asked. A favorable large trigger means that the large triggers, the same ones that are used to define momentum on your small chart, are wide and angled in the direction of the trend. But also the synthetic triggers. And synthetic is this clever way of saying the large triggers from the large chart. That's way too wordy. So we call them synthetic, and they're nothing more than the large triggers from your large chart. When your large triggers and your synthetic triggers are one on top of the other, when they are wide, when they are angled in the direction of the trend, we call this favorable large triggers. Call it favorable large triggers because the tighter that they are on top of one another, the less amount of risk you're likely to have in a trade. We call them favorable large triggers because large triggers are a correction point. They're a moving average. And we expect price to come back to that moving average. But a moving average on its own isn't typically enough to stop the market. That's why we're going to plant areas inside of them, fibs, midbands, yellow 1-to-1s. And I want you to think of it as if you're throwing a baseball or a tennis ball or a racquetball or a cricket ball if you're British. And when you throw it and it hits the trigger line, I don't expect it to bounce. I don't expect just a moving average to stop that market, to reverse it, to go with the trend. But when I give it something solid to bounce off of, whether it is a fib, a midband, or a yellow 1-to-1, inside of that correction point, I have a better chance of the market continuing with the trend. When my correction points are split, we're going to call this split triggers, I don't know if it's going to go from the native correction point or if it's going to pull all the way back to the synthetic correction point. And guys, once again, you have to say to yourself, it's loose. They're split. My area is huge. Hell, I don't know. And when they're split, It's a great idea to wait for a little confirmation. Maybe you wait for a reversal bar from the furthest correction point. Maybe you give yourself just something that says, this isn't my best look. This isn't rule number 3. And I really want everything to revolve around advantages. So guys, favorable large triggers gives you the tightest area, the tightest window of opportunity. Favorable large triggers gives you the least amount of risk. And favorable large triggers allows you to refine that broad stroke of a brush to the most precise point. This shows the refinement process. When the large chart is down, the large chart has momentum, and the large chart says that it's time to look for a trade, we're going to sell high on the smaller, faster chart. Areas inside of favorable large triggers define where high can be. By selling high, we increase our profit potential. By selling high, we're going to reduce our risk. So when the large chart is up, when the large chart says go, when the large chart is screaming to the upside and life is good, and it's going to look a lot like this, guys. We're going to wait for a reversal bar on the smaller, faster chart. This is the entry sequence for a long trade. At the time of the reversal bar, we do not enter the trade. We do not enter on the reversal bar. The reversal bar signifies the beginning of a pullback. It signifies the start of the fight that the small crowd is doing. Once we see the reversal bar, though, and eventually, really even before it happens, you're going to start looking at your trigger lines and you're going to say to yourself, where are they? Are they one on top of the other? Are they wide? Are they angled in the direction of the trend? If they are, then I know that they're favorable, and this is where I'm going to look for my areas. So I turn my attention from those trigger lines and I look at Fibonacci areas inside. I'm looking for mid bands, yellow 1-to-1s, and fibs. I want you to notice that this Fibonacci support is not inside of favorable large triggers. Therefore, it's not a part of our window where the market is most likely to continue. And you guys are going to get tempted by the siren song. I'm going to tell you right now, and I see it a lot every day. If my expectation is that the market is likely to continue to these trigger lines, and my expectation is that I need something for it to bounce off of inside of these trigger lines, guys, down here, I'm beyond the correction point. I'm beyond where the expectation of the market to reverse is, and it's no longer a high probability trend trade. And at this point, it becomes a lot of hope. I hope this area might hold, but hopefully it never even gets there, because you guys are going to activate a limit order at the top of your window of opportunity, closest to price. Because remember, the large chart is absolutely screaming to the upside, and the large chart doesn't have anything to bounce off of. So we don't expect that push to be too terribly big, and we're going to activate a limit order 1 or 2 ticks above the area of support inside of favorable large triggers. Or if we're going short, we're going to wait for the reversal bar still. The rules don't change, and guys, we can make money either direction. At the time of the reversal bar, you guys will look for your favorable large triggers and then find the areas within. And this is one of those magical unicorn moments where there is one line. There is one line inside of favorable large triggers. There is one point in this market where I expect it to continue. These yellow 1-to-1s, these fibs, all of this nonsense up here beyond the trigger lines, this isn't a part of my window of opportunity. My window of opportunity is precise. It is 1 tick wide. And I'm going to activate a limit order a couple ticks below it, and I'm going to take that trade if the small crowd is capable of pushing it there. So we talk about these tails a lot, and I say go back and circle tails. Look for these tails. Learn to recognize the rules being met on the large chart. And if you go back historically and you circle a tail, it should line up with an area inside of favorable large triggers. And if it does, congratulations, you have a high probability trend trade. If the momentum is there, if the path is clear, and if that reversal bar takes you back to an area inside of favorable large triggers, guys, this is the best of the best. This is the look that I want you to go back and study. This is the look that I want you to fill up your favorite looks section with. What does an awesome short look like? It looks like momentum. It looks like a pullback right to resistance inside of favorable large triggers. That's the look I want for a short. What's my perfect long? It's odds favorable. It's a clear path, and it's a pullback right to support inside of favorable large triggers. And guys, this pattern repeats itself on every chart. This pattern repeats itself on every market. This pattern repeats itself in the futures markets, the Bitcoin market, the Ethereum market, the Tesla stock market. It doesn't matter. It's just a pattern. And as soon as you can identify the entry, guys, life gets easy for you, because once you know where the market is likely to continue, you also know where the market shouldn't go. And this is where your first stop comes in. And one of the biggest signs of the maturing process of a trader is that they manage their risk before they ever manage their profits. You guys have already begun managing your risk by having momentum in favor of the trade. You guys are also managing your risk by making sure that the large chart hasn't reached an area. You're managing your risk by patiently waiting for the pullback, and you're managing your risk by waiting for the entry where it's most likely to continue. A pattern that has been proven over decades. 27 years we've been teaching people to let a termination hold and then sell or buy a pullback. This is nothing new. But once you can define your window of opportunity, you can put your initial stop 4 or 5 ticks beyond it. If the market goes there, you don't want to be in the trade. Once you define your window of opportunity, your stop goes 4 or 5 ticks below it, because if it goes beyond the correction point, well, now we're starting to get out of that high probability scenario. And the cool thing is with all those advantages, more often than not, you'll get a reversal bar in the direction of your trade, which means that you're going to reduce your risk even further, 2 ticks above, 2 ticks below. And guys, it's not uncommon to see you guys post in the room where you take a rules met trade and you move your risk 2 ticks below that reversal bar, and then the trade doesn't work. Guys, that's okay. Anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. But what happens is you can take a 3 or 4 tick loser instead of hoping and praying that that market does what you want it to do, and losing $150, $160 per contract. So understanding where the market is likely to continue is really the key to being able to manage trades. Understanding where the market is most likely to continue is what sets you up for success. And I want you to see this. It finally broke, didn't it? Support, resistance, support, resistance, support, resistance. There's one of your pivot stop outs. That pivot stop out reverses everything. Small smash through. The large didn't quite make it. It gave us one of those tails. What did that tail look like on a smaller, faster chart? Whoops. Let's find out. Holy smokes. That termination reversed the market, created odds favorable momentum, gave me the potential to break this area. And sure enough, it pulled right back to resistance inside of favorable large triggers. Is there anybody in the room that said to themselves, I recognize this pattern because of my study. I recognize that termination that reversed that gave me momentum. I recognize the pullback back to resistance, and I just got paid on it. Cav, 32 flavors of kick-ass, brother. Ace J, you got it? Beautiful trade. So guys, is it a coincidence that I just spoke of it and Cav caught it perfect? Guys, that's the accumulation of your study. That's your going back, studying, circling tails, recognizing looks, and saying to yourself, I know exactly what it should look like when I have the best of the best. Is it any coincidence that when it hit Fibonacci support, look at that, 1, 2, 3, 4. Look at all the divergences right off of Fibonacci support. But they sure did have the potential to break, didn't they? 10K, the small triggers had smashed through. I was. The small triggers smashed through, right, 10K? Let's make sure that we get this lesson. This is my charts right now. I know you took it. I just showed it and bragged about you. You may have missed that. But 10K, this is that 50-50 look. Small triggers are breaking through. Large triggers have not. It has the potential to break. That's what I want you to know. And then because it has the potential to break, I want you to see how it's set up on the smaller, faster chart. I have odds favorable momentum. I also have a small window of opportunity. There's no divergence. And then most importantly, I'm coming from the termination condition that created the reversal. And guys, this is a trade that I love. This is a trade that wins typically more than it loses. It's not a high probability trend trade, but that's what we call that 50-50 trade, where areas have the potential to break. And then 10K, this KISS plan has that entry in there. And I want you to see something pretty cool, guys. And I'm about to introduce you to the KISS plan. So what we're going to do is we're going to illustrate what it means to have a plan. And I'm going to do that. Cav, you're my guinea pig today. We're going to take Cav's chart. And I'm going to take a picture of it. And I want you to see what having an effective plan does for you. So this is the rules for a trade that I'm about to put in front of you and talk about. And this is a 50-50 trade. It means that the smalls are through and the large are not. That's what the 50-50 means, guys. 50% of my triggers have broken, 50% have not. This area has the potential to break. So Cav says, I better have odds favorable momentum on the 13-2. Sounds good. Adriana, I hope everything is great for you and have an awesome weekend. And I will make sure that I talk through them so that you can watch the video and get your feedback. Enjoy your weekend. And then Cav also says that my small triggers had better be outside of the large over here. He's confirming momentum since the path isn't clear. And then Cav said, I can't have divergence on the 5-1 because that means a loss of momentum, and I'm not giving up momentum because the path isn't clear. And Cav says, it better be coming from a good top or bottom, a termination that creates a full reversal, because I want to know that decisions were made at key areas, and from that decision, the market ran fast. And Cav says, holy crap, everything is a yes. I'm going to get in at the lowest point of resistance inside of favorable large triggers. So what Cav did here is Cav said, my rules are true. That's all he said, is my rules are true. My rules for entry are true. That one happened to line up 100% with the KISS plan. And that's what I'm giving you guys right now. I had a trader tell me, a trader that I respect very much, Mark, if you don't have a written plan, you don't have a plan. If you don't write down what it takes to get you into the market, you don't have a plan. And Mark, this is where opinion comes into play. And Mark, this is where your emotions are going to get the better of you. And Mark, if you don't have a written plan, how can you possibly make it repeatable? How can you be consistent? And I said, geez Louise, I get it. So I wrote a plan, and I wrote a plan for all of you guys. And this plan is a stepping stone in your learning journey. As you learn to read your indicators, guys, this plan will change. But this one is designed to optimize your chances of success with the 50-50 trade, with the high probability trend trade. And here's the kicker. It's going to be through simulation, study, class feedback, and continuous practice. That's your part. That you're going to have to create a plan tailored to your goals, whether it's momentum trades or counter trend trades or HVA trades or momentum trade or whatever they are. You're going to create your own plan based on your ability to read the indicators. But until you can do that, this is a plan that optimizes your chances of success. Isn't that a pretty magical phrase? Optimizes your chance of success. Gives you the absolute best chance of success with the high probability trend trade and the 50-50 trade. Success creates confidence. Guys, I've had people get funded in those accounts within their first 30 days with Nexgen by following this simple plan. I've had people that have gone wayward and rogue and started trading everything and losing lots come back to this plan and find success. I've had people tell me that I'm absolutely full of shit, pardon my French, everybody, And when I challenge them to give me 5 days on this plan, they come back and go, respectfully, it turns out I was chasing everything, not the best. So this is designed to optimize your chances of success, guys. This is designed to make you confident, to turn you into a chart reader. And everything starts with not fighting the large chart. You're going to be tempted to with your opinions. Don't fight the direction. Don't fight the momentum. Don't fight the areas, guys. Those are the most common mistakes that new users make. And if you can not do that, you're already doing 60 to 70% better than the average human. And then you're going to define your entry. And notice that your is all caps. Notice that it's bigger. Notice that it's highlight. Guys, this is your plan. This isn't the Nexgen KISS plan. It's presented as the KISS plan. But in order for this to be effective, this has to be Haji's plan. And this has to be WiseClick's plan. And this has to be Farok's plan. You have to own it, love it, like you gave birth to it. And you're going to define your entry. And this plan also has great pictures of strong tops and bottoms and strong triggers and terminations and entries. But the idea is that you just define your entry. And I've never had anybody stick to the high probability trend trade be able to mark yes to each and every one of these and do worse than 70%. I don't know about you guys, but I'm here to get paid. So until I learn how to do it on my own, I'm going to follow the path that helps me get paid the most often. Once you define your entry, you're going to have to do something with it, guys. Your entry for the brand new user is very mechanical. Your entry for the brand new user has only 3 rules. It only uses 2 charts. It keeps your brain function as low as it can possibly go to still find success. And that's really the goal of it, is because the more you take the high probability trend trade, the more opportunities you begin to see outside of it. So your management plan should be just as mechanical. We found that for the new users, if it is just as mechanical as your entry, you find the highest level of success. If you eliminate your fears and your opinions through very pragmatic if-then scenarios, it heightens the chances of success. So this very basic management plan begins with you entering where the market is most likely to continue. So if you can't define your entry yet, this management plan is going to prove to be a little difficult. So focus on entries first, because your initial stop has to go where the market shouldn't. And if you can't create that window of opportunity, how are you possibly going to know where to put your stop? And I want you to see one of the most common stops. You took the best entry ever. You had momentum. You had a clear path. You had every advantage. And you got in at the best of the best spot. And you said, man, with everything going my way, it's all sunshines and rainbows, but I really don't want to risk more than $50. Let me put my stop just below resistance inside of favorable large triggers. And that small crowd said, hey guys, remember those guys that were too scared to put their stop in the right spot? Let's go stop them out, bounce off of those one-to-ones, and run to the target. And I see this so often with new users. So stops go where the market shouldn't, and you have to be able to define where it should bounce before you can define where it shouldn't go. And once you're in, there's nothing to do. You're either going to get stopped out. Guys, 2 or 3 every 10 trades you're going to get stopped out if you're following the rules. Every 100 trades is 20 to 30. And that's hard to fathom for new users, but I want you guys to believe me when I tell you that losses are a normal part of a positive equity curve. It's rare that I ever see anybody not take a loss. You'll have the one-off days where you're 100% because you're so focused or the market's just playing nice. But the reality is you're probably going to find yourself, if you're taking medium probability trades, if you're taking HVA trades, if you're taking momentum trades, you're probably going to find yourself closer to that 50% range, which is where stops become so important. So if it goes in the direction of your trade, with all those advantages, you're going to reduce your risk. You're going to drop it down. You're going to make sure that if they decide to not play nice, you lose less money. And it makes it easier to take the next trade. And at this point, once again, there's nothing to do, guys. You're either gonna take the small loss, or it's gonna run to your first target. And this first target's only $100. And $100 feels good, guys. $100 is money in your pocket. It goes in your account. They can't take it away from you. And you're going to move your stop to break even. And you're going to do that not because break even is your best stop. Remember, you're going to formulate a plan based on your ability to read the indicators. But break even says, hey, you've been paid, you have no risk. Let's see if we can just hang on for the second target. Let's see if we can trust odds favorable momentum. If we have it in us to believe that that clear path is advantageous. And guys, if you just sit on your hands and wait, that second target gets hit more often than it doesn't, and it's a $300 trade. And I want you guys to remember, there was one bar on the large chart. This represents my one bar. Let's make it fat. There was one bar on the large chart that said down. There we go. There was one bar on the large chart that said odds favorable momentum. There was one bar on the large chart that gave you the information you need to take this entry. The bottom of that bar was the beginning of your pullback. There we go. The top of that bar was the top of the move. One bar. New users move stops too soon and they get stopped out right there. New users panic and get stopped out before the second target. New users tend to let fluctuations on the small chart make them forget that the large chart was screaming down with absolutely nothing in the way, and all these little ticks, that's all it is. This one large chart bar is nothing but all of these ticks. And if you focus on the ticks, guys, it's going to scare the ever-living crap out of you. But if you focus on the advantages, if you focus on the methodology, if you focus on just following a very simple plan, it's going to help you remove a lot of that emotion out. So guys, this is your KISS plan. Identifying your entry. Here's a checklist that you can print out and put on your desktop so that you can understand what it is you're looking for every time it's time to pull the trigger. You can police yourself each time you've taken a trade, and more importantly, you know exactly what advantages you should be talking about every time you look at the chart. And then for my newest users, here's the same checklist with pictures of each advantage. Just a little something to get you the visual. So let me drop that in the room as well. Guys, this is my first hour every hour. When we talk each day, we talk about the advantage of momentum. And once we have the advantage of momentum, we say to ourselves, well, do I have a clear path? And guys, the answer here is no. Prices reached yellow 1-to-1s, and none of the triggers have broken. Rule number 2 isn't met. And I'm pretty much obligated, because I'm a rules-based trader, to say, hey, my rules aren't met. I'm going to sit on my hands and do nothing. I'm just going to wait and see what the large crowd does, what the small crowd can pull off. And I'm opening up another one. So are there any questions about the high probability trend trade, guys? Are there any questions about momentum? Is there any clarity that I can provide on termination conditions? Is there anyone struggling with entries that really wants to go through that process 1 or 2 more times just to make sure that they're clear? And I ask this every day when I'm done. And guys, I can't see your faces. Even Zorro's head's turned the other direction in the picture. The only way that you won't get what you need from Nexgen, the only way that you won't get what you need from this classroom is if you're too shy to raise your hand. So I'm going to take 5 minutes and I'm going to take a break. And I'm going to leave you guys, hopefully you take a break too, because I'm going to tell you right now, guys, sitting and staring is a horrible recipe for success. It's okay to get out of the market. It's okay to sit on your hands. And it's pretty cool when you recognize pullbacks to resistance inside of favorable large triggers. Dag nabbit, this market's good. I'll be back in about 5 minutes. We're going to go into the second hour. I'm going to start looking at the pictures that you guys posted. Before I do that, I'm going to remind you that I am not the trade police. I am not here to tell you you did great or bad. I'll probably tell you you did great. But what I will do is I will talk about advantages. I'll talk about advantages every time that you guys got into a trade. I'll talk about whether you had momentum, about whether you had a clear path, whether or not you had the advantage of an entry inside of favorable large triggers. And I'll do that no matter what style trade you're taking. I'll do that whether it's a momentum trade or whether it is a high volume area trade. We'll talk about all these key concepts because chart reading is the goal of the class. So it's imperative, guys, if you take a trade that's outside of the high probability trend trade and you want help, and let me stress that, if you want help, son of a gun, you have to tell me what you're looking for. Otherwise, I'm going to talk about advantages and tell you that you got lucky or that it's a nice trade. But this isn't your grandmother's refrigerator, guys. I don't want you to just post up here so you can walk by it and feel good about your winner. I want to see everything that you've done. I want to see your winners. I want to see your losers. I want to see your questions. I want to see everything that you've done, and I want you to tell me what you've done because the quickest way to get to where you want to be is to get feedback. And if you made a mistake, how are you going to know if you're brand new? And if you got lucky, how are you going to know if you're brand new? And if you're just doing stuff for the sake of doing stuff, guys, that becomes problematic. So make sure that you're telling me why you did what you did. And I will be back in about 5 minutes. And it looks like I'm going to spend a minute trying to fix my stupid Ninja Trader. I'm just about at wit's end. I'll see you guys in 5 minutes. Mic silence. All right, guys, let's get going while Ninja Trader's up. I'm going to scroll up to the top. So, Rob, let me show you how to do that. All you have to do, Rob, is to get it over to your desktop. Is really you can just click on it, left click and hold it, and then just slide it over and put it on your desk. And that'll work. Or you can also click the download button, and that download button will put it into your downloads folder. Right click, reload all historical data. Should get you taken care of. All right, guys, I'm going to scroll up to the top. You and I have the same gremlins, Rob. And we're going to start taking a look at some of the charts that you guys have placed. And we're going to talk about it. We're just going to talk about advantages, guys. You need to tell me what you're doing. And we're going to see what's going on. So Gino's got us going. And Gino says, whoops, I skipped a couple. That's okay. We'll start with this one. Gino says he grabbed one small momentum. So Gino, termination, full reversal, odds favorable. You let it clear the one-to-ones and you're out at trouble. And Gino, that's a beautiful momentum trade. Beautiful momentum trade. Great entry, great exit. Love everything about it. Momentum for the win. Right here, we have weak triggers at a fib. And I want you to see, Gino, and this is an important piece, guys, and this is where I think that understanding your rules helps you anticipate reactions. So your entry, neither the small nor the large have gotten through that area. Neither of them have gotten through, and there's not much strength in the market either. There's a loss of momentum, and it does ultimately go down. But I want you to see what happens. Is this line creates this bounce, which means that, honestly, you can anticipate it. You can almost anticipate a bounce. And then what I love to do, and Gino, I hope this is helpful, is when it's not perfect, but it's good, right? This can create a bounce. This can create a bounce. Let it bounce. And then when it starts heading back below it, look for your opportunity. That way, if this bounce ends up going all the way up to here, you don't just get run over. Does that make sense, Gino? Now we're just fine-tuning. Your chart reads are awesome. And now we're just fine-tuning. If you know that it's a little sketchy, right? Let it start back down below. Like, let it do its thing and then go back below. And I think what you'll find, and that's not trading advice, that's just letting price get to the other side of an area. But if you go look at that pattern and see how many times it repeats itself, I think you'll be surprised at how it can bring a little success to the table. And then GWC dropped one in the room. Let's see what you did, GWC. Why not? Because it's already done everything that you wanted it to do, right? It retraced, it got back below the area, the large chart didn't blink. Yeah, just sell. If that's your plan. Go back and look at it. Go look at how many times you see those bounces right at the fibs. And this is a great example right here, it's virtually the same look, right? It's almost the exact same look at the divergence high. And if you waited for it to go back up, you wouldn't have gotten stopped out on the big pull. All right, GWC. Let's see what we have here. I believe this was GWC. Let me double check. Don't want to say names and have people going, wait a minute. Yeah, this is GWC. So let's see what we have here. Are you in the room? Yep, cool. So just for grins, you've identified the termination condition, right? And you've said, that's a termination condition that reversed the market. That's a strong bottom. Is that where you were going with this one? Because I love it. That's a strong bottom. So let's look at it real quick. coming up where you're looking, you mentioned green backgrounds. I like that. And your small triggers are below the large triggers. Do you see how that really doesn't say strength? Because if we go back to strong triggers, they look like this. The smalls have to be above. So I don't have strength on the small chart. But before we get to the small chart, I think what we've done is we've put the cart before the horse. My small triggers are up, absolutely. My large triggers are working their way that way. So the momentum isn't horrible here. It's the beginning of odds favorable. But I have 1, 2, 3 areas that haven't broken yet. So at best, this is one of those 50-50 trades. Does that make sense, GWC? This is a trade where the area has the potential to break, but it hasn't broken yet. So what does that mean? You know that there's a reason that I said it. It means that I don't have a clear path. That's what a 50-50 trade is. It means that there's no clear path. So I cover up the clear path, and just this little hiding it gives me the understanding that I shouldn't sacrifice momentum or an entry area. My momentum should be the best of the best because I'm expecting it to break an area, like 3 areas. So what happens is one divergence can spoil the party, without a doubt. And it does. It pushes you all the way to the lower end of it. And if you took it here with one divergence from the termination, at least you had a fighting chance. That second lower divergence says, man, GWC, we're going to push lower. We're going lower, and that area is probably not going to break, and we're just going to take your money. So this was a great lesson that we had yesterday, is when you understand what kind of trade you're getting into, or you understand even more so the large chart and what it's telling you. So the large chart said from a strong bottom, and I love it. And the large chart said momentum, yeah baby, but the large chart said areas not broken. Uh-oh. Let there be momentum and a tight area for entry on my small chart. And this is what I say, guys, when I'm talking to myself in my office and I'm looking at my charts and I'm getting ready to take a trade. This is the exact process that I go through. I'm like, man, look at that strong bottom. I love that. I just got tingles. Look at that momentum. Holy smokes, that's the kind of momentum that has the potential to break areas. And then I go, oh, but those areas aren't broken. Let me make sure that it doesn't suck over here. And strong triggers. And I'm like, yes. And I'm like, uh-oh, divergence. That's the first sign that things may be slowing. If I get in, let me get in low because it may push lower. And then that's the one that kills it. So, and then just, I know you have a range chart over here. Even if you were using the range chart for confirmation, you still get in on the first pushback. And you'll notice that when it starts coming back down, there's never any sort of confirmation afterwards. So maybe that's helpful as well. But even without the range chart, understanding that it's not a clear path, I believe pays huge dividends to keep you out of that trade. And it doesn't cost anything to stay flat. It doesn't cost anything to avoid a trade that doesn't give you the advantages that your money is worth. And I hope that makes sense to everybody, not just GWC. GWC was just nice enough to post in the room so that everybody can be a little bit smarter. So thank you for that. Joel, termination, full reversal, odds favorable, not a clear path, 50-50. But your momentum trade checklist is met perfectly, right? Breakout of support or resistance, middle chart strong momentum, snap back to the area and make easy money. And Joel, great momentum trade. Large chart leads the way. But where on here does it say clear path? It says breakout, and that's exactly what you got. You got the breakout when those small triggers absolutely railed through. and you let it confirm on the small chart. You could have also taken this one. It gave you 2 shots at that momentum trade. Joel, great job. Great recognition and beautiful exit. Getting out at the area that has the potential to stop the market. So really nice trading, Joel. And then Gino. I'm going to start looking at all yours at the same time so I can stay zoomed. All right, Gino says strong bottom. And Gino, that is an absolutely perfect read on the bottom. That is a no triggers through termination condition that reversed that market. And then odds favorable on all charts. Gino, you're absolutely right. You do have momentum on all charts. Entry of confluence at 1-to-1s and mid-band. Didn't expect to get hit, but will increase your, and then that's a cliffhanger. So it already happened, and then you put it together, right? So you missed it and said, oh crap, I hope it comes back for me. Is that right, Gino? I've done that. Man, come back and get me, come back and get me. And I don't know what happened here, guys. I don't know what happened after this trade. But what I can tell you from my read as well is, Gino, you hit a mid-band, and those large triggers were a full bar away, which meant that your synthetic triggers were all the way down here, which means that if you caught it right off the top, I love it. That's momentum. And then if it does come back, that's where you start to see things come back and close the gap to those triggers. That's the gap theory. And it's a correction of price. And when price accelerates away from those large triggers, and they're a full bar away, you can see that they're below the reversal bar marker here. That's when price is most likely to come back. That's when this trade is most likely to fail. It typically gives you the first shot with all the momentum, but now your bars are getting inside. You're getting out of that momentum phase, and it does go down. The potential decreases after that first hit, especially when the gap theory is in place. And then your next picture, divergence printed. You're putting the previous picture up. Completely murdered momentum. Large trigger showed too much risk. Took a loser. Thought this one would work. Actually thought about backing up the truck. So where did it go from there? And this is kind of cool when I can look at your chart and then come back and see. Notice it? It's beyond the correction point, Gino. Or not just Gino, everybody. Remember when we talked about triggers are a correction point? And when you have one correction point here and one correction point all the way down here, you just don't know where it's going to go. And then when you add the gap theory to that, smack dab into a mid-band, no area is actually inside of the triggers. Hopefully you guys can recognize how that begins to compound the potential problems. And this is where you've got to silence that little voice in your head that says it's going to go without you, Gino. It's going to go without you. I know it doesn't look great, but man, it's going without you. And I don't know what it did. And then Cav, we talked about this one, the perfect 50-50. Odds favorable from a good top, no divergence, tiny window of opportunity. Everything is absolutely perfect for a 50-50 trade. So you took it, which I love. And then VM Tech. Welcome from the beyond. And guys, this is a pretty cool thing that you can do. Is VM Tech messages me in the morning and says, hey, I can't be in your class, but I can go back and watch the recording. So here's my chart, and then I'll catch the recording. So that's what we do, and this is pretty outstanding because what it does is it gives VM the opportunity to still get feedback, to still get the education, to still get everything that they need, even though they can't even attend class, guys. So let's see what we have. Started at around 7:15 and waited for it to pass through the yellow 1-to-1s and the blue fib. So sat on her hands for 30 minutes, or his hands. VM, I don't know if you're a he or a her. I apologize. And just waited for the trouble to break. And then when it finally gets below, you'll notice that the entry is taken. And this is pretty cool because I want to say this is the exact same one that you took, Gino, where because it's not completely a clear path, only a little bit of price has gotten below the area, not the triggers, we can expect some sort of reaction, right? So you go short, and then it bounces as we would expect from a line. And then if you just let it go back below, you get the same entry price and you've already had the reaction. And I think that this is pretty key for you guys that are trying to just nip through an area. Wait for a reaction, right? And if it doesn't give it, cool. But more often than not, it will. So let it react and then come back down, and then it makes it easy. And then when you get here, everything, you're in that clear area. And I love that you define the clear path. And then you got out at the bottom of your shaded area, right where it may stop. And it didn't, but this is awesome. Like, I love this. And this was your goal. Once again, goal met. And I don't know if you guys have noticed this, but VM's posted 3 or 4 times this week. Every one of them says, let the area break. Every one of them says, get out of the area that's trouble. And I think that you've done a spectacular job of it. Not a clear path once again, and this lower entry is going to get you if your stops are too big. So if you're going to take this one, you've got to define where is the market most likely to continue, or where is the market most likely to go. And in this case, it's got to be mid bands right at the triggers, which means your stop is way up here, and you're hoping that the area breaks, not allowing it to react and then break. And I think that that's a pretty good lesson there. For everybody. Good stuff, guys. And I got to tell you, this is one of those days where I'm looking at y'all's charts and you're just reading them like a boss. Everybody's killing it today, and it's fun to watch. It really is. All right, Gino, there's that 50-50 from a good top. Got involved in the fight. Definitely downward momentum. Man, you stress my eyeballs. Definitely downward momentum from a good top when you got in. Small triggers turned green on me. Stayed in on the strength of the large chart. Strong resistance above. Eventually broke your way for a winner. Clearly could have gotten more, but seemed to have lost your coconuts. All right, so let's talk about it. Because I want to save your coconuts, Gino. Your coconuts are my responsibility today. Did you catch the lesson when we talked about the termination creating the reversal is super great? And then a 50-50 is more likely to work from the reversal. So it's a KISS plan. Have you looked at this yet? And I'm saying that kind of jokingly, but all right. So just for grins, guys, like shits and giggles, have this on your desk and look at it. And if you looked at it, what you would say to yourself is this is the perfect 50-50 trade. And then let's talk about your one thing about the small triggers. And I know that you're thinking NASDAQ, right? So when you get up here, your small triggers are a full bar away still. Did you notice that? And it's hard to notice in the moment when the market is screaming. It really is. So when you got up to the top of your window, dude, your small triggers were still a full bar away. So for you NASDAQ traders, and I'm going to tell you guys right now, if you're trading the NASDAQ and you haven't gone through this section, looked at every picture and asked me questions about it, you're shooting yourself in the foot. Because I blew out 11, 12, I don't know, 173 Apex accounts learning those lessons for you guys. When you're in the window of opportunity, brother, those trigger lines are a full bar away. And there is absolutely no way I'm not going at the area. But here's what happens. There you go. There it is again. TLC, there's the whole spreadsheet. So steal mine. It's right above you. On the NASDAQ, Gino knows that these small triggers can jack up your day, right? And if they're closer than a full bar away, they may create a bounce. They might act as support. So Gino had that in his mind. So awesome, Gino. You're saying, let's watch them. They're important. I know they're important. And then the second half of that lesson is that if your smalls are a full bar away when you get to the area, dude, get in at the area. Because remember that this is a 13.2. This is a 34.5. So the same idea that on the large charts, and I don't know where my charts went again. Like this is your large chart on crude. So if they're a full bar away, I'm always in at the area because I've got room to correct. My risk is established. It's pretty minimal. And then when they're not a full bar away, when they're on the other side of that reversal bar marker, it looks like odds favorable, everything's up. But when I get to the area, those small triggers are right on top of me. And sure enough, they just scream down. So Gino, awesome job thinking about those small triggers on a NASDAQ trade. They will turn against you guys. Your small triggers will turn against you on almost any trend trade you take. But look at what the triggers look like on the large chart. Remember, this is a smaller, faster chart, 15 to 30 bars, fluctuations. Small triggers have to turn to get you back up, but they're only getting you back up to the top of that tail. And notice that it's right at an area. Notice that it's inside of the triggers. This happens a lot. Great stuff. So why? I don't know. Were my rules met? That's the question. Were my rules met? So here is odds favorable, clear path, no divergence, perfect entry. Here's a pullback again, right to mid-band inside of favorable large triggers, and here it is trying it again. As long as my rules are met, why not? I don't know why you exited other than fear. What got you out? The divergence? Fear, okay. Because, man, by the time you're down here, you're on the right side of everything. That's okay. It's important to understand that. TLC, are you checking all the tabs? I've had people tell me that they don't have a lot of it. There's tabs at the bottom. Because if you just downloaded mine, if you just took the one from the room, it's right there. And I know it's right there because when I open it up from mine, this is what it looks like. So make sure that then you're looking at your old one. You're not looking at the one that you just downloaded. Go to your downloads folder. If you just did it, you probably have 2 copies of the same one and you're looking at the old version. Because mine definitely has it on here. And if there's only 2 tabs, then you're looking at your old one. So I would click the download button and then click on the one that downloads. And that should open up mine, not yours. Or give me your email and I'll email you mine just so that we can pull any human error out of the equation. But you should be able to get it from the room. Either way, we'll get it to you. Promise. But Gino, all that to be said, great job, dude. Great job being aware. And that awareness is part of the chart reading. That awareness is part of recognizing when it could be good, when it could be bad, when it could be better, when advantages are going away, and you did a great job with it. So nicely done. All right, Miss Adriana, I know that you're at the doctor's right now, so let's go through and see what you did. So need to manage this trade because of bottom. Where did you send your email to, TLC? I don't see it. Did you DM me? Yep, you did. Okay. No worries. I'll get you at my next break. Cool. I got you. Don't worry. I'll send mine over. Go ahead and... So when I send it over, it's going to look exactly the same as what you have. You're going to have to save it and either overwrite what you have or save it as a completely different name and then combine the two. All right, Miss Adriana, we're going to talk about your chart, and I know that you're only watching this on the video, so I want to make sure that I'm really thorough with it since you can't ask any questions. The first thing that I need to know is, what does this mean? You need to manage this trade because of bottom. Does that mean that a pivot stop out with no triggers through, you don't identify that as a strong bottom? Which is okay. But remember that a termination condition that reverses the market, Adriana, this is a strong bottom. This is the best of the best. And just because there's not a Fibonacci area there doesn't take anything away from it. It's a pivot stop out, which means that the sellers had their momentum stolen. And then when they tried to go again, the buyers said, go to hell. Didn't even let triggers get through and reverse the market. So this is the absolute best of the best. You got it, TLC? Cool. And then as you're coming up, and this is what we talked about earlier, you're trading into the area rather than trading from the area, which makes you a little nervous sometimes, right? Because we're not getting the advantage of a clear path. You're literally coming right off of a fib, and you're not sure. I don't know. Is it going to break? Is it not going to break? And then this is divergence potential. And this is a very key concept for you guys. You're going to see that negative number flashing on a smaller, faster chart. It means that the potential for divergence is there. But divergence isn't true until that number prints, until you get that line, magenta line from a high. So I see people a lot of times getting nervous on the potential of divergence. And the reality is now Adriana, and I believe this is the one that Joel took, I want you to see some really cool stuff that happens here. Is the small triggers break on the small chart, and it snaps right back to support, and that's our expectation. That is the perfect momentum trade. You took it into the area, which adds a little bit of the nervousness as you get up here, because that divergence potential could mess you up for sure, and I love that you know that, but you're really looking at a breakout, and then that's your next entry. So I'm pretty sure it went up from there. Nope, her entry is below, Bob, right there. You can see she's at break even now because of the potential trouble, which is smart. Actually, no, her break, she is at the fib, isn't she? I messed that one up. Bob, thank you for that. Nope, you don't got me. I messed it up. So it's perfect. The entry is exactly where it should be. The small triggers broke and pulled back. For some reason, I was thinking that was your entry, and I apologize, Miss Adriana. Her entry lets it break and pull back, and that's the perfect entry. That's a momentum entry, guys. That is trading the breakout. Potential to break from a good bottom. Let it break through, pull back, giddy up. Perfect. And I apologize. I messed that one up. So Adriana, it's perfect. The only lesson in this one is that this is a strong bottom, and this is a great indicator that longs are more likely to work, or W-Rock. Beautiful trade. Great job. And guys, I love seeing your entries. Make sure that you spend a little time showing me the exits as well. I want to see what you guys did with them. What do you want to do with the Nexgen trade tracker? What do you want to do? Jonathan, do you want to open it or do you want to save it? So what I would do is I would save as, And I would pick a spot where you can always find it and name it something that doesn't already exist. And neither of them worked. So do this then, Jonathan. Go to your downloads folder and you should see it right there. Try that for me real quick. Because it has downloaded. And then from here, right click on it and click open and see if that works for you. Do you have Excel? I guess that would be the question too. Do you have Microsoft Excel? Was that no the answer to Excel? Sorry, I was looking right. Okay, so what you had is a Microsoft Excel version, and no matter how much you want it to, it's not going to open if you don't have Microsoft Excel. So let's do this. I am going to, here, let me take mine and do it. So I'm going to go File, I'm going to go Save As, and I'm going to save it as Open Document Spreadsheet. All right. And I'm going to call this one Tracking for Jonathan. And I'm going to save it over here where I can find it. And I'm going to save it. So once I save it, what I'm going to do is I'm going to come back. And I'm going to drop that one in the room for you. So that's an open document format if you don't have Microsoft Excel. So you're going to need this openoffice.org to be able to go through and play with it. Ta-da! And that should get you taken care of. And that should get you all the access that you need. And let me see where I'm at here. All right, Cav, gonna take a look. Market coming from a good bottom. Price hits resistance, pulls back. Blue mid-band triggers never broke. Placed a limit order inside of the triggers with the order placed. All right, so let's talk about it, Cav. Not a good bottom. And I hope you're in here because this is a great lesson, guys. Awesome, Jonathan. What's it take for it to be a good bottom? And this is a pretty good question here. Because you're saying it's a good bottom, but the only way it becomes a good bottom, the rules for a strong top or bottom, guys, no, not price break. This is a termination condition, and this is a termination condition, and it becomes a strong bottom when it reverses the market. So this is just a termination condition, and this termination went to a termination, and it came back to a termination, and it went back to a termination, and it's playing a little bit of Pac-Man there. So where you get in, you're coming from the termination, but the large triggers are still down. The large triggers, the large triggers for the small chart are up. You go long, and I'm not sure what kind of trade this is. Maybe it's a momentum trade. But it can't be a high probability trend trade. Maybe there's an HVA line there. But for whatever reason, it doesn't stop you out. And then it still hasn't rolled in divergence prints, and it pushes all the way down to the pivot stop out, and it still hasn't stopped you out. And then a second divergence prints, and now it's starting to look a little more like a trade. And then you get out. That's, I get it, but you're trading into the termination conditions, and the synthetics are still down, and without an HVA or something in there, with the large triggers still inside and below, stuff like that, it's a lower probability trade. And I'm glad that you were able to sit through all that nonsense. I'm not even going to say that. What do your rules say? I mean, you say that you stayed in due to the strength on the 34.5, but the large triggers were down on the 34.5. The small triggers were barely even working their way inside, right? So when you say you stayed in due to the strength, is that because it hit support? Because it hit a fib? Okay. So what are your rules for entry? Could you share them with me? Do they say when support holds and the small triggers roll, I take a pullback to them? Not a strong bottom at all. It's just a termination. And I guess that's what I'm trying to get at here. It's just a termination. That was a termination. That was a termination, and that was a termination, and that was a termination, and that was a termination. And all of these were terminations until they finally weren't, right? And that was a termination. So terminations are awesome. And I'm not trying to argue the point with you, but at what point do you trust a termination to be a bottom, if that makes sense? At what point does this termination condition become a bottom? And guys, everybody has different ideas on it. Some people say, I'll wait for 3 divergences to confirm it. Some people say, I'll wait for a higher divergence to confirm it. Some people say that I'll wait for the large triggers to get above the synthetics so I have a fighting chance. Some people will say, if it comes off of a fib and these small triggers roll, I'll take the first shot at them and go. And the only reason that I bring this up, Cav, is if you're not sure, and I'm not saying that you're not, but if you don't know why you did it, if you're not sure why you chose that entry, then you need to be able to write a plan for entry so that it can be the same entry every time. And then the same thing is if it is a momentum style trade because of the termination condition, doesn't multiple divergences negate that? No, if the triggers don't break below the fib, it's a termination condition, Cav. And this is where we find people trading half-truths. And it's okay. Let's go to termination conditions real quick. Let's open up the book, because sometimes language is important, isn't it? So we're in the termination condition section. The recipe for a termination condition is first that price reaches the area. So let me see if I can take a picture just of this one straight out of the manual. The recipe is first that if price reaches an area and the triggers remain below, it's a termination condition. That's the first part. It usually moves up or down from that look. Okay. So I'll skip the lesson on termination conditions. All I'm asking is how you did what you did. That's all I'm asking. If price reaches an area and the triggers remain above, it's a termination. Price reaches the area. So that recipe never changes. And I think this is where a little bit of confusion sets in. And this is where lessons begin to merge until they're really solidified. The recipe for a termination condition will never change. So terminations at a low. Price has to reach and the triggers remain above. And this looks pretty similar, doesn't it? A double hit. Price reaches. Price creates the pivot. Price reaches. Now it's a termination condition. And strength is a relative term, right? So what is strength? Is strength a termination condition? Is strength momentum? Typically, when we talk about tops and bottoms, when we talk about termination conditions, the first thing is you're absolutely right. It not breaking is very advantageous. Price reaches the area, no triggers break, right? That's a termination. And then once it reverses, then we use the word strong for the first time. Then it's a strong top. Price reaches, it's just a termination until it reverses. And look at this. This is a good example. It's a perfect termination all the way to the termination. The trigger's never rolled. It never was a strong top. So when I'm using the language, and I do believe language is very important. So when I'm using the language for a strong top or bottom, this picture really kind of sums up the process for getting there. First, its price reaches the area. And then, when none of the triggers break through, it becomes a termination condition. It's like a termination condition is born. And this is nothing more than an area not to go short into. This is nothing more than an area not to go long into. And maybe I don't say that enough. A termination condition is nothing more than an area not to go long into, not to go short into. It's a waving red flag that says the market may reverse, it may bounce, there may be a fight. The reality is that I just don't know. But if from that termination the large triggers roll, we get everything the way we need it, that reversal in the market from large triggers going from green to red, it's not until here that it's a strong top. And a strong top is kick-ass right up until the next termination condition. And then it's still a termination condition. And then you reach it. I'm doing it right now, literally right now on this picture. This is a termination condition because price reached the area and the triggers didn't break. Watch this. We're going to get it, I promise you. Price reached the areas and the triggers didn't break. Termination condition, right, Cav? You're okay with that? And this is the key. This is everything that starts. So check this out. Here we go. Termination reverses the market. Now it's a strong top. So there's your termination. Now it's a strong top. And these are amazing questions. So the same thing is true over here. There's your termination. Just a termination, just says don't go short. And then once those triggers roll, look how long it took it to be a strong bottom. There you go. Not when the trend reverses, when the large triggers go from red to green or from green to red, because you can get those triggers above and still not get a reversal. And then there's your termination. It becomes a strong top. And notice that the smalls are on the wrong side. The trend never changed. But because the large triggers rolled, we're going to call it a strong top. So what you run into is there's divergence. Price created it. This is not a termination condition. There's that next lesson coming in. Does that make sense? Just a pivot with a loss of momentum, not a termination because price didn't reach anything. Price reached the mid-band. The large triggers are about a full bar away. Now the mid-band's behaving as a termination condition, but this won't be a strong top unless these large triggers roll back to red. I think great questions. Absolute great questions. And guys, these are important lessons. And it all stems from once the termination creates the reversal, it's a strong bottom. So termination may reverse the market, may create a bounce. And look what it did, Cav. And maybe this is This is that patience piece. Price reaches it, there's your untradeable bounce. Not going short. Price reaches it again. There's your untradeable bounce. Not going short. And now we're starting to say that this termination reversed the market. And there are opportunities to be had off of a termination condition. There is your first shot. And the easiest shot, Cav, is when the large get above. When the smalls are above the large, not buried in the large, right? You actually have momentum. You actually have had that higher divergence. Over here is the easier one. And I'm not saying that there's anything wrong with your trade. It's your trade. But there's a huge difference between an aggressive first entry and an entry that gives you an advantage, taking care of that bottom, letting the triggers kind of slow down and do some things. And when I go into my might versus has picture, this is one of my favorite ones. Yeah, no worries. And Cav, thank you for raising your hand and saying, man, something's not clear. Because this is what makes the class amazing, is I'll go over it and I'll try to think of different ways to say it. Because I know I say the same thing every day, but not everybody hears the same thing, right? Not everybody hears termination condition isn't a strong bottom. No, you're not. Actually, you get the gold star today because you ask questions. You're not sitting there wishing that you had answers. So outstanding. So check this out. And Cav, this is another one that really kind of helps. Is price reaches resistance here, and this is probably a termination condition on the large chart, right? And you're like, ooh, that's a termination, I'm going to go short. And then you get stopped out, and you're like, no, my trigger's rolled, I'm going to go short, and then you get stopped out. And you're like, well, shit, I'm going to go short, and then you get stopped out. And if you're just a little bit calm and waiting and feeling good about it, eventually the large triggers roll. Eventually the small get to the business side of the triggers, and this is where it becomes easy. And all this is that fight. That's that decision making. So termination conditions are awesome, right? But termination conditions can create a fight. They can create a bounce. I talk about it every morning, where I show that fight on the large chart straight from the manual. So a little bit of patience goes a long way. When you just kind of let everything roll through, it creates this huge advantage. And if you go back and you ask yourselves, how many times did I hope that a termination condition would reverse the market, right? How many times did I hope that that was going to be enough to get me up here? And how many times did I hope that this was going to get me up here? And what you'll find so often is that the market does fight at these areas where you think it's going to be a short, but it's going to bounce a little bit before it becomes a short. Or you think it's going to be a long with weak triggers and it's not there. And there's that fight in between. And guys, one of the advantages that the software offers is that we don't get caught in as many fights. So now I have a bad bottom, right? It's not a termination that created a reversal. It's not a strong bottom. And I have a 50-50 trade. I have smalls above the 1-to-1s, but my large are below. I've already had one divergence. So if I'm looking for a high probability trend trade or that 50-50 trade, I'm going to sit on my hands and wait and see if this divergence potential becomes true. Because my rules say with divergence, I can't take the trade, which means that right here at these 1-to-1s, I'm risking trading directly into divergence. So I'm waiting to see. And notice how divergence, it's still just potential. So we may get two lessons here. If you're going to trade the breakout, let it go back up. But there's your divergence on a 50-50. So now my rules aren't met from the KISS plan, because it's coming from a bad bottom. And guys, this is the stuff that you have to work through in your head as the market is fluctuating. This is the stuff that you've got to work through in your head as you're watching those ticks go up and down, which is why the easier you keep it in the beginning. The more focused you keep it in the beginning, the more simple you allow your rules to be in the beginning, the less likely you are to get confused, the less likely you are to make mistakes on what could be the easier trades. Does that make sense? You have to know your rules. You have to know what it looks like. And you had to know that from a bad bottom, a 50-50 with divergence is less likely to work. Because you know that your rules say, I can't take this trade. I have to wait for the path to clear. And if you tried the momentum trade, well, your smalls are inside of the large. You don't have momentum. Does that make sense? I don't have odds favorable momentum. I have a weakening of the triggers. So guys, you really have to know what you're looking for, and then you have to know what it looks like, and then from there you have to be able to piece it together to form your trade. And I think this is where a lot of us fall short as traders. Is we say, okay, I've seen strong triggers 10 times. I know what it looks like. I've seen termination conditions. I know what they look like, so I'm ready to be a trader. And then we stop going back and reinforcing those rules. We stop going back and saying, you know what? I'm still getting good at this. I'm still kind of new. Let me just blow up my large chart and take a picture. Let me take a picture of what I see on this large chart. And just to reinforce lessons, let me point out with yellow arrows everywhere I had strong triggers. And let me point out with red arrows when I reached a termination condition. And let me point out with white arrows when I had strong triggers in one of those tails. And let me go through and let me just reinforce this stuff where maybe I had the gap theory, where I saw divergence, but then I remembered that this isn't a termination that reversed the market. It was just a loss of momentum. And now I see a pattern that tends to repeat itself. And it's just a divergence that didn't stop the market. And I'm at that trouble spot. And because I've taken this picture 100 times, I might pause when I get to the mid-band from a bad bottom. You guys see how that works? And it's pretty cool because you're going to begin to learn these patterns and you're not even going to realize that you're learning these patterns. But if you don't take 10 minutes a day for your first 90 days and come back again and take that picture, and maybe on this one, price didn't reach an area and it reversed. That's a bad bottom. Triggers got through the area. That's a bad top. That's a bad bottom. Price reached the area, none of the triggers broke. Eventually it creates a reversal. Wait a minute. That's a good top. Right over here. And what you do is you start going through and you reinforce these rules, right? And if you're not sure, watch this. This is the Nexgen magic, guys. Hey, Mark, I'm working on good tops and bottoms. Did I get this right? Because you did the work and you said, hey, Mark, do me a favor, check my homework. And I'm going to go, yeah, that's a good one. And that's a bad top, right? Because the triggers get through and man, it didn't make it. And wow, what a great job. And now you're like, okay, not only do I think I know the lessons, but now I've gotten confirmation from that guy whose whole purpose in life is to teach me these lessons. And that's the part that I think people skip, guys, is really saying, I got this. I got this. I know what I'm doing. And it's okay to think that way. And a lot of you guys have heard this story about the 30-day stupid. And forgive me for saying stupid for you guys whose feet are a little tender this morning. But the 30-day stupid is based off of this idea that I had when I was training managers in a previous job. And I would give them a checklist. And this is a restaurant industry. And I would give them a checklist. And I would say, if you follow this checklist, you're not going to have a bad day. If you follow this checklist, you'll be on time. If you follow this checklist, you won't lose money. If you follow this checklist, every shift that you ever had is going to be smooth. So these new managers come in and they say, heck yeah, I'm gung-ho, I'm excited, I'm going to follow this checklist. And they do for about 30 days. And then right at 30 days, they start saying, man, I've got it, I know it, this is mine, it doesn't matter anymore, I don't need the checklist. And that's where I see people losing trades. That's where I see people breaking rules. And it's right at about 30 days when you're feeling super confident. And so it's important that you guys understand the challenges. Joel, if you're going to tell me what you're doing on another chart, I need you to show me the other chart. You're working on a plan with a white chart and an HVA line, but you're not showing it to me, right? How do I know if you used it correctly? How can I give you feedback on something that I can't see? I see a pivot stop out where everything says down from a good top. And then I see a second higher divergence, and I see all of this indecision. And then I see you on the wrong side of small triggers on the NASDAQ, and I see you getting paid for it. But I don't have any idea if you used it correctly, so I don't know if it's repeatable, so we're good. All right, Andy, momentum, clear path, strong bottom. Andy, what are your rules for a momentum trade? I know. So let's talk about momentum. And Andy, I love where your head's at on this one. I'm not going to lie. You're saying because of the momentum and a clear path, you're going to look for a momentum trade on your small chart, right? Do you have rules for entry beyond just jump in and hope? Just curious. Do you have momentum rules? No. Okay. So that's going to be your first thing, is maybe come up with some rules for entry. So if you don't have rules for entry, then you probably don't have rules for exiting, right? Would that be safe to assume? And that's okay, because that's what this classroom's for. So check this out. You're getting in and you've got odds favorable clear path, right? And I don't disagree with your entry. Everything is screaming to the upside, Andy, and it's good. And your bars haven't closed on the wrong side of the smalls. But the second this reversal bar prints, can we agree that the momentum phase is over? So if I were building a trading plan, I would say if my sole reason for entry is momentum, it would make sense that a loss of momentum, i.e. close on wrong side of the smalls, is a good reason to exit my trade. Does that make sense? Five bars prior to what? The loss of momentum? So because it lost momentum too soon, you said, F it, I should stay in this trade because that's not enough bars for me. I'll just sit and hope, right? Well, it's only been 5 bars, and it told me that it was losing momentum, and it showed me that it was losing momentum, but you know what? To hell with it. I'll stay in that momentum trade. And if that's what you thought, well, then I think that's flawed thinking. But if And because you haven't defined it. And that's what we're doing right now is we're defining what a loss of momentum looks like, right? It has nothing to do with how many bars it is. This was a loss of momentum as well. So if you were in this momentum trade, it would have been appropriate to exit right there. And this is how plans are built, Andy. So I'm nothing but love for you right now on what you're doing to help yourself build this plan. And we're going to go through a lot of scenarios on this chart. You are. You don't have any idea how much smarter you've gotten. I see it. You guys should stop. So Andy, let's do this. If I have momentum and a clear path, don't I also have an area of support inside of favorable large triggers? What kind of trade is that? You lost your coconut to the ocean. That's just a high probability trend trade, right? So check this out. I think you're really going to like this. The easiest momentum trades, Andy, the easiest momentum trades that you could ever take are when the bars are outside of the small triggers. This is called the momentum phase. See how the bars are outside of the small triggers? So when they're here, when they're outside of the small triggers, this is the best look of momentum on the small chart. And this is where those momentum trades have the highest success rate. When they come to the wrong side, you're losing momentum. So that's a perfect exit right there. And at this point, they never break back outside. So this momentum trade is not destined to be short-lived, but it has less chance of being successful because you're no longer in the momentum phase. You've already weakened them a couple times. So just knowing that keeps you kind of focused in and ready for this exit. Does that make sense? And now here comes the mind blow for all you guys. No, we're just going to keep doing it. So if you do get divergence and you're cool with this trade, your stop has to go where the market shouldn't. And that's a lot of risk, isn't it? So you either have to get stopped out, maybe create a line below the bar that gets you in, and say, you know what, if it comes below that, things have gone wrong, I'll exit. But I can tell you that I've taken trades before, and I see people take these trades, and they get in here in case it runs, right? Because this is flying to the upside. So they get in, whoops, in case it runs. But Andy, they've already got it into their head that if it pulls back, it's just a high probability trend trade. And I've even seen people add contracts right here. If it pulls back, I'll add contracts and I'll get out up here. And there's nothing wrong with that. And people think that going back to simulator is a failure. Andy, it's not. I've gone back to simulator 700 times. Every time I learn a new concept, I go back to simulator. Every time I trade a new market, I go back to simulator. Because I like keeping my money, right? Guys, when I went to the NASDAQ, I didn't go to simulator, and I blew out a lot of accounts. But what you're doing, Andy, is you're saying to yourself, hey, Mark, this is what I'm doing, and this is what I thought, right? And this is why I did what I did. And you're absolutely right. You nailed where the high probability trend trade was. So what I'm doing is we're just going back, man, and we're building great lessons. It's just like the putting greens, just like the driving range, the batting cages. Guys, it's learning to be an open water scuba diver in a 4-foot pool first. It's a little safety net. That's what Sim's designed for. So guys, please don't ever think of simulators as a failure. But the lesson that this goes back to, and the most important thing ever, the most important thing I think that you could ever take from everything that we talk about, guys, is if you don't know what sort of trade you're in, how do you know how it should be managed? And that's one of the biggest things. That's one of the biggest things, guys. So Andy, you knew this was a momentum trade, right? And because in your head you say it's a momentum trade, you say, okay, momentum in, loss of momentum out. And now you know instantly that a loss of momentum takes you out of that trade. But Andy, you're freaking brilliant. And you say, and this is where, guys, this is where piecing it together comes. If momentum loss takes me out, I'll look for the trend trade. So you're not saying, damn it, I didn't get paid. You're saying, well, I'm just looking for the next best opportunity to get paid. But you have to know what you're getting into. So let's just see if there's a live example. Hey, look, 2 divergences on a 50-50 from a bad bottom. Ain't that some stuff? And then we get a higher divergence. But you notice how the large triggers are green and the small triggers are red, and they're flat even when they're red, which means that you don't have odds favorable momentum. And your triggers are split and not wide. You don't have favorable large triggers. And now the market appears to be going up with what is momentum. And the market appears to be going up with what is a clear path. And my small chart appears to have what seems to be a mid-band rising up right inside of triggers, one on top of the other. I haven't gotten to it yet, Andy, because we turned into the biggest lesson ever on your last picture.
Order canceled.
Because there was so much great information there. My favorite professor at the University of Houston, he taught an English Lit class. If you were an English Lit major, you had to take his class. So Andy, let me ask you, where's my little mouse here? There it is. Try it again. Let me ask you. So what? But now it went to the fib. So what? You weren't in the trade. That has a lot to do with it, Bob. So what, Andy? If you had done it right, you would have been in here. You would have taken profits here. You might have stayed in because 2 divergences doesn't scare me. But Andy, you would have exited on the 3rd divergence anyway if you were following rules. And this would have been your stop because 3 divergences may reverse the market. It's a termination condition, which means that if you were following your rules, you would have never made it to the fib anyway, would you? It's Friday. I go preachy on Fridays. It's okay. So Andy, if you take a picture that says, if I would have broken my rules, I would have been paid, what is that teaching you? That's teaching you that you should be breaking your rules, right? Hold on. This 50-50 had 2 divergences, and if I just would have held my stop a ridiculous amount, I'd still be long, getting paid. And weak triggers and multiple divergences said, get the hell out of the trade. But if I just would have kept my stop up here, I could have gotten some of it back. And I know, and guys, that's part of it, right? That's part of it. Part of it is being able to analyze in the moment, to be able to say that I have odds favorable in the clear path, and to identify an area inside of those triggers, and then just to say to myself, if the market comes back and gets me, I'm in this long trade because my rules are met. And if the market doesn't push back and get me and it runs off, who cares? It means that it wasn't my money. It means that it wasn't meant to be. But do you guys see it? I've got odds favorable, right? Oh, and it hit my entry and didn't fill me. I've got odds favorable, and I've got a clear path, and I had an area. Ooh, let me get,
Order canceled.
I need some sort of, so let's say we got in, right?
Order filled.
Where shouldn't the market go? About 5 ticks below those triggers. So now my stop's in place. All I had to do was follow the rules. In any other market, that's my $100. And now I'm break even. All I had to do was follow my rules. All I had to do is sit on my ass and do nothing when there's nothing to do. And gosh, I love it when the market gives me this, right? So with all that momentum and a clear path, is it safe to assume that they're trying to get to fibs? But because one-to-ones can create a problem, maybe you say, hey, you know what? If that divergence potential becomes true, I'll exit the trade. I'll give myself a little cushion. But if it never becomes true, if this just remains potential, well, then I'll stay in for the bigger move because my large chart says momentum. My large chart says a clear path. Does that make sense, guys? You've already been paid on the first contract. There's zero fear on the second contract. It either goes or it doesn't. What does your large chart say is more likely to happen? Up or down? Up. Can we agree that the odds are favorable for the market to continue up? Can we also agree that if the market pulls back to a mid-band inside of favorable large triggers, that's a ridiculous stop? And honestly,
Order submitted.
that's another entry condition. What do you guys think? I have odds favorable. I have a clear path. I have a mid-band inside of favorable large triggers. I'm going to keep my stop below. Remember, you'll develop a plan based on your ability to read the indicators. And if these yahoos come back to the mid-band again, son of a gun, I've already been paid. I can't lose money on this trade, but I'm going to add that contract back on. Give me a Y if you guys see that.
Order filled.
All right, I'm long again. Where shouldn't the market go? I like my stop, right? So now I'm long 3. So maybe what I do is I sell 2 of them at $100. Oh, 3, what is that? 2939. So I believe that is the equivalent of $100 there. My rules were still met, weren't they? I still have odds favorable. I still have a clear path. I still had a pullback to an area inside of favorable large triggers, and I still have a stop where the market shouldn't go. And maybe the safer stop is a few ticks beyond the triggers, but that still gives me a trade. I've already been paid on one. And guys, this one might be one of the 20 or 30 that fail. But all I'm doing is trading my rules. And that's the part that I want you guys to get out of this. I'm not forming opinions about what the market's going to do. My indicators say that with odds favorable momentum, a clear path, and a pullback to support inside of favorable large triggers, I have a 70 to 80% chance of this one winning, which means that I also have a 20 to 30% chance of losing. And I don't fear losers. I fear execution. It never reached the one-to-ones, Dano. The one-to-ones are a 100 exact projection, 100% to the tick. Fibs are made up of areas. One-to-ones are an exact number. And if they don't hit it, then it's not there. So what am I waiting for right now? I'm either waiting to get stopped out or I'm waiting for a reversal bar. And those are my only 2 options, guys. And I don't care if it wins or loses, but I want you guys to recognize is that if you focus on the rules being met, and you believe through your study and your participation and your class feedback that this is in fact a trade that typically wins more than it loses, well, then you don't feel bad if it loses. You don't feel bad if it pulls back. One of the things that I know about divergence is this divergence is likely to take out the previous pivot, which means that I put my stop where the market shouldn't go with all that momentum. It means that I put my stop beyond the point where I expected it to bounce, and if that turns into a reversal bar, I'll reduce my risk behind the reversal bar. Does that make sense, guys? How are we feeling about it? Large chart leads the way. Small chart is nothing more than an entry chart. There's my reversal bar. I'm below the reversal bar. My first target's still in place. But do you notice how the smalls are below the large now? I no longer have favorable large triggers, which means that if divergence prints, a lower divergence prints, I'm going to exit that trade. I'm going to tell you right now, if a lower divergence prints, I'm going to hit close. But I'm not going to get scared on the potential of divergence. I'm not going to worry about the potential for divergence. It's going to have to happen. My large chart still says up. I took the perfect entry. I've got my risk where it belongs. I mean, I feel pretty good about it. I don't know what's going to happen, though. I could sit here and watch these ticks fluctuate all day long and give myself heartburn. Man. Whew. Terrifying, isn't it? Isn't that kind of cool? When you get to the point where your only options are to follow your rules, but you have to know your rules and you have to know what they look like. And I think that is really what I'm trying to point out here, is that the second I form opinions, I'm going to put myself in harm's way. The second I deviate from my plan just this one time, I put myself in harm's way. And this one may come get me. I don't trade the Russell enough to know if I should be worried about those small triggers, but my plan says keep my stop behind the reversal bar. So I'll just keep it behind the reversal bar. It's the Russell. But do you notice that my stop is also on the wrong side of everything? And look, it got me. Dang it. We still made a little money in there, right? We're down 40 bucks for the effort, with the potential to go to the fibs with odds favorable and a clear path. Does this mean that the long trades are over? Not necessarily. It means that I need a little confirmation on this chart before I consider going long again. But I think it's okay to walk through that. Guys, for all of that, that was minus $40. That's not a very big loss, is it? Rob, do it again. Because you only copied your call out. I do that a lot. And guys, I guess that's a good thing. Through a pragmatic management plan, $40. That was 2 trades. That's $10 a contract that went away with the potential for fireworks to the upside. Rob, copy your picture again and drop it in the room. You only got the call out box. We're not going short into one-to-ones, right? Whenever it does that, Rob, here, let me give you a visual. If there's the white dots on it, it'll just give me the so what. So sometimes I'll just come and click off to the side a couple times to make sure that nothing is highlighted there. There was your divergence. There's your small triggers down. There's your large triggers down, but it's directly into a termination condition. What do you guys think? Is the market going to go up or down here? See a lot of setups daily like this. So am I good enough to manage? I don't know, Rob. Are you? Why don't you talk me through what you see? What do you see here that makes you think that's a potential trade? What do you see here that says, hey, this one might be worth adding? Because if I don't know that you know why you got into it, how do you know where to get out? So from a bad bottom with weak triggers, Rob, what do you suppose your first target is? Would be a mid band. I'm going to give you the answer. You're in the momentum phase of the small triggers, but you've already reached the mid band. So you go to your small chart and you say, let me just see if there's a reason here for me to go up. And there's no loss of momentum and strong triggers in an area. I don't know. You might like that trade. That may be something that you do. But how could I possibly know if you're good enough to manage? Where would you take your exit? Why would you take your exit? Why did you take your entry? What preceded your entry to make you feel better about the trade? Don't equate money with talent. Trust me on this one. Do not equate money with talent. People always go, but Mark, I made $100 on it. But Mark, I made $1,000. I know I fought momentum and direction and I traded into termination conditions, but I made $1,000 and that proves that this is the right trade. Everything that you do, Rob, should have a statistical advantage. Everything that you do should have the ability to be repeated. Everything that you do has got to be able to be found 100 times, and it has to win more than it loses. And that's how a trade enters your plan. So I'm not saying that this isn't a great trade, but what I am saying is that if you don't know why you took it, if you don't know what the expectation is from a bad bottom into a mid band, if you don't understand what negates looking for the entry, momentum is great, right? Let's go see if we can find some momentum. Well, shit, that was all sorts of momentum, but it was right into a termination condition. That too was a lot of momentum, but it didn't work out. And that was a lot of momentum that did break. So what I'm getting at, Rob, I'm going to show you one of my favorite patterns. When I have a bad bottom with weak triggers, the mid band is my first target, always. When there's no divergence, the mid band is even more likely to hold. So when I have a bad bottom with weak triggers, the mid band is the most likely first target. And it may overrun a little bit, but when I have a bad bottom, the mid band is the most likely target. When I have a bad bottom, the mid band is the most likely target. When I have a bad bottom, the mid band is the most likely target, and it may overrun a little bit. Those are good tops and bottoms. There's a bad top, triggers through, pulls back to the mid band. There's a bad bottom, goes to the mid band. And so what we're doing, Rob, pivot, didn't reach the area, pulls right back to the mid band. What we're doing is we're looking for patterns that repeat themselves. We're looking for patterns that we can go back and find it 100 times. And with that 100 times, we can say this one is more likely to win than it is to lose. This is a pattern that repeats itself more than it doesn't. So you're asking if you're good enough to manage. And I'm not saying that you're not. But what I'm saying is that if you've already hit the mid band and you're in at 83 and the mid band is right here at 90, what happens if the mid band holds? Are you prepared to manage out? Because you'll notice that you're on the wrong side of the momentum phase too, and that bar started coming back to you. Are you willing to hold that one with the loss of momentum on the small chart into the mid band that has the potential to hold based on where the large chart is coming from? And that's where the chart reading comes in. And Rob, this is where keeping it easy initially keeps you from misunderstanding lessons. So before I really understood the gap theory, I was going long. Before I understood bad bottoms and patterns, I was going long up here when this told me that I shouldn't. And guys, it was embarrassing for me because I was in my brother's classroom and I would post, I'm in a long trade. And my brother would be like, yeah, and we're going down here, and this is the most likely outcome because of the bad bottom. And what I realized is that I didn't do my due diligence as a chart reader before I started trying to take trades that really relied on my ability to recognize patterns. And then if you're in a trend trade, if a trend ends, you should exit. Bob, it sounds logical, but why don't you tell me what your trend ending scenario is? How do we know that a trend ends? And Ace J, I'm looking, brother. What time did you post it? And I apologize if I missed it. Or if you wanted to repost it, you would save my bacon on that one. Not seeing high probability. Well, you're not seeing high probability trend trades, Rob. All right, so guys, now I have to tell the story again. Grant, I think we looked at all yours. Did we not? Guys, am I missing charts? And it happens sometimes. Because remember, sometimes if you go P, I do look at your charts because you don't say, hey, Mark, I'm going P, don't look at it. So Grant, here's one of yours. Entered short once everything broke through, had momentum, 1-to-1s. You take a momentum style trade and you get out with a loss of momentum. So Grant, there's one of them. And that is absolutely beautiful. Just using momentum, letting it get to the other side. You do get in, right? And it does come up, and it could have gone up anywhere because it's a 50-50, especially with divergence. And it worked out. It's a nice trade. Guys, please, if you ever notice that I miss a chart, tell me as soon as you can. Don't let me get way ahead. I missed some at the beginning. All right, thank you for that. Guys, this is where I've got to say I screwed up. Do me a favor, repost if you don't mind. It's easier for you to drop them in the room real quick than it is for me to scroll through 3 hours of chat. I will scroll through 3 hours of chat. It was my mistake, but you'd be doing me a solid. Rob, you played sports, right? And I know we've talked about this before. Stepping up to the plate and wanting to hit a home run doesn't result in a home run. Going to the batting cages, learning how to keep your back elbow up, learning how to step into the ball, learning how to swing through the ball, learning to keep your eye on the ball. That's what produces home runs. Doesn't matter how much you want to make money. What matters is how well you execute. And until you can execute, you're just hoping. Termination. Awesome. Have a great weekend, Ron. So here's your termination. Back to a mid-band, large sugars, full bar away. Another termination. Back to resistance, starts to roll. Lots of momentum. 50-50. Perfect entry. So what's the challenge with it? And Ace, without knowing your rules, it's hard to tell you. because a 50-50 with divergence is problematic. A 50-50 with two divergences is problematic. And you say your entry would be 81. Okay? And your target would be 8069. I love it. So with two divergences, do you get in on the way up on the 50-50 or do you get in on the way down on the 50-50? Okay. So what happens if this 50-50 does what most 50-50s with two divergences do and runs you over? I like it. If you got in, easy money down to the fib. You could have gotten out at the one-to-ones as well, and that would have been a great exit as well. The idea is that when you get to trouble, it's okay to take profits. When the smalls are still outside of the large, at least it has the potential to break. And notice how they weaken when you get to the fib. I love that. That's a good look. Nice job. You just got to watch those 50-50s, right? And make sure that if you were in here, second divergence on a 50-50 says get out. So that reversal bar gives you confirmation. It's a great read. All right, Grant, I apologize for missing you. So there's the first one. So one of the breakout rules, is if you're going to trade a breakout, the easiest way to do it is to let the small triggers, especially one-to-ones, let the small triggers get through one-to-ones. And this is just a little Grant, it's going to make your life easier. Let the small triggers get through the one-to-ones. Otherwise, you try to trade momentum, which is what you're trading, and there is none on the small chart. I mean, the small triggers have even turned against you, right? And it can't really be a 50-50 with weak triggers because you're not expecting the area to break with all that weakness. So you get caught in this dance. And that's a difficult place to get caught because you don't know what's going to happen. Notice that the one-to-ones held again. But if you're looking for that breakout scenario, once you start to get clear of the problem, once the small triggers get clear of the problem, it makes it a lot easier. Awesome. Thank you for that, Kev. And I hope you have a great weekend. So I dig it, but sometimes that dance, Grant, is where hope kicks in. And you can see, whoa, that's huge. You can see that you're caught between a fib and those one-to-ones and the triggers aren't helping. So if you just let it clear a little bit, it creates an easier scenario for you. And then your exit, first profit. And then once again, when you get divergence and weak triggers, it's a tough hold, right? Why not get paid? And then if you're going to take a chance on this one, again, weakness, nothing inside of favorable large triggers. I always ask you guys, how did you know it was going to be the mid-band and not the one-to-ones and not resistance? How did you know it wouldn't go to this resistance or this one-to-one, or that it wasn't going to be one of those weak triggers pushed back to the mid-band, right? So when you're catching it on the way up, guys, and there's that much indecision, there's weakness, the only thing that you're relying on is a clear path. And you had it here too, right? And you also had it here. So we go back into predictable. We go back into patterns that repeat themselves. And Grant, again, I can't tell you how to trade. That's not my job. But what I will always do for you guys is I'll tell you that the easier, more likely to win trade is from the other side when the triggers break the problem. I'll tell you that without momentum and without an entry area, confirmation, if it never stops and continues up, you never get stopped out from those weak triggers. If it decides to go this time to the one-to-ones, you never get stopped out. If it decides to go to the fib, you never get stopped out if you simply wait for confirmation. And then what's the flip side of that? You're going to pay a few ticks for confirmation. weak triggers, second higher divergence, and you hold the trade. Once again, how do you know it's the mid band? How do you know it's here? Where do your stops go? And I think that you're letting the large chart direction lead the way. You're letting those triggers down lead the way. Just have a plan is all I'm saying. And a little confirmation goes a long way. If you kept your stop in place on this one and waited for confirmation here, then you could move your stop above that one and then continue down. But this one didn't even have divergence, and that's the one that pushed all the way up to here. Does that make sense? Ace, it depends on the trade, doesn't it? And I guess that's what I'm saying. So what kind of trade was this one, Ace? High probability or 50-50? 50-50. So if it's a 50-50, I don't have a clear path. Does it make sense that if I don't have a clear path, that I insist on momentum, that I insist on an entry area? So when I look at yours, I've got a loss of momentum. And because it's a good top, one loss of momentum, I might take that trade. Two divergences, two losses of momentum, especially a higher divergence, man, now it's becoming kind of a crapshoot on whether or not it's going to continue down. That's the look, Ace, that I see so many 50-50 losers come from. So it worked this time, but more often than not, and let's go Exhibit A, that second divergence kills a 50-50. Do you see it? So now we're trading probabilities. So if I say if there's two divergences on a 50-50, the only way I'm going to take that trade is with a reversal bar. I never get stuck out on that lower probability trade. So you fought the probabilities and you won this time. But is that the most likely scenario on a 50-50? And let's go see if we can find another 50-50 that kind of looks the same. And that's all I'm talking about, guys, is just probabilities, is giving yourself the best chance of success over and over. So if I go back to 924, let's just see what happened, just for grins. And I know you guys think I'm an asshole because I'm always talking about this. Man, why would you do this? So there's your 50-50 at 924, right? No divergence and it bounces. One divergence, it gives you a second chance. Second lower divergence, it runs your ass over. And if you waited for some sort of reversal bar for confirmation, it keeps you out. It keeps you out of that. So that's all we're talking about is what is the most likely scenario. So if we go to the live market, 50-50, not from a good top. Divergence prints, no areas inside of triggers. So I don't have a high probability trend trade. I don't even have the best entry for a medium probability trade. I don't have the perfect momentum. Is there anything wrong with waiting for a reversal bar? What do you guys think? I'm not saying that this is your trade, but if you're hell-bent on taking it, just hover over sell market and wait for the reversal bar. Notice that the triggers didn't get through the one-to-ones. Seeing this a lot on you guys that are sitting through mess on momentum trades. I'm not expecting a mid-band not in a correction point to hold. So give me a reversal bar, but a reversal bar puts me right back into those damn one-to-ones. Maybe sometimes it's just better to not take the trade. But that's what you guys have to decide. So my apologies if my preachiness upset anybody. I never mean to, but you're absolutely right, Bob. I'm trying to give you the best chance of success. Guys, you have the rest of your life. This is a marathon. You don't have to be in every trade to be profitable. You don't have to be in every move of the market to be profitable. What you have to do is understand what you're getting into so you know how to get out of